Good morning. It is Monday, January 9th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith and Brian Southey. We've got futures that are pointing to a higher open here this morning. S&P futures pointing to a gain of about 0.5% at the open. Dow futures up about 0.25%, and Nasdaq futures up 0.5% as well. This is coming off of quite a strong week for stocks last week. If you look at the S&P, and that's because of the big end to the week, of course. On the back of the jobs report, we saw a 2.25% gain in the S&P 500. That brought the gains to the week. Not to huge gains, but it was enough. I guess that's a reflection of how weak the weeks have been, that this was the biggest one that we've seen in quite some time. So that's the setup for this morning as we look ahead to a lot of news this week, Saz.
Expert chart work, Julie. All right, speaking of news, earnings season is around the corner with big banks kicking it off this week. JP Morgan, Citigroup, Bank of America, and Wells Fargo are among the names that will be reporting their fourth quarter earnings this Friday. Investors will be keeping an eye on how their mortgage businesses are holding up and listening for signs of optimism on the broader economy. Lots to unpack here with these bank earnings. Guys, is this the quarter where JP Morgan CEO Jamie Dimon again brings out the warning on the state of the economy? He certainly could. He's been, I think, very out in front warning about where this economy might go in 2023. Is it also the quarter where JP Morgan starts to pull back on some of its tech investments given the slowing economy? So those are a couple things I'm watching as pertains to JPM. And then, of course, on news today of Goldman cutting 3,200 jobs. We knew it was coming, but still to see it is I would say, concerning. And how does that CEO, David Solomon, get on that earnings call and project his business looking forward? Yeah, those job cuts coming after we had already seen from JP Morgan and some of the other banks as well, even prior to or during the holiday season, saying that, hey, we're going to need to roll back on some of the bonuses. And that really kind of brings into question what the total compensation package for the existing and the retained base of employees would look like going forward, as the banks are really waiting for deal making to come back in full force, waiting to see where investment banking really kind of regains some type of strength given some of the equity market declines that we had seen in last year. And so with all of that in mind, this earnings period and what they forecast perhaps is going to be the biggest kind of takeaway item in what they're seeing in terms of deal making and where they're going to be able to drum up some type of demand for their investment banking products as well.
Yeah, when we look at the Goldman news this morning, it reminds me a little bit of what we've seen from technology, because part of it is sort of a pandemic payback, if you will. That is, Goldman Sachs usually does an annual culling of its underperformers. It cuts them. Didn't really do that during the pandemic. So part of this is sort of now a delayed reaction, a delayed cutting of some of those folks. That's at least some of what is going on there. But we are perhaps going to hear more about cutting from these companies, especially given that maybe they're not totally prepared for what may be coming at this point. For example, Deutsche Bank last week downgrading Bank of America, JP Morgan, and Truist, saying that bank stocks have yet to fully price in a U.S. recession. So are investors fully accounting for the effect this could have on the banks? Are the banks themselves fully accounting for the effect? I think we're going to get lots of discussion around those issues.
Right. It seems like there's a disconnect, Julie, because I'm looking at some Morgan Stanley price target changes ahead of earnings. They are cutting estimates on Citigroup and Goldman Sachs pretty significantly. But if you go pull up the KBW Bank Index, as we're showing here, these stocks have gone nowhere, really nowhere over the past year, despite rising yields, and theoretically that should be good for profit margins. I would argue that chart is suggesting, we're in a recession at some point this year, and that impacts a lot of the businesses beyond deal making for the banks.
This runs a little bit counter to what we typically see from some bank activity, at least during a rising interest rate environment. They typically would be more beneficiary where they can get more money or earn more from the difference between some of the spreads in their loans. And I think for right now, they're still trying to manage what many other businesses are and trying to understand exactly what their cost structures look like. The cut that we're seeing at Goldman is roughly double what we had seen at Morgan Stanley. That was about 1,600 employees there. And so exactly the number of people that they need in order to continue the operations or the business as usual, when business right now isn't kind of that usual operating procedure, if you will, too.
Yeah, just to take a step back, if you look at the big businesses of the banks, right? Net interest margin, the difference between what they put out and what they take in, basically, and what they lend, that's going to obviously be a big focus this year. Fee income related to everything from mortgage servicing to the deal making that we were talking about. All of these things are going to be in flux this year and are difficult to predict, I think.
Absolutely. Well, something else that we're tracking here, and our second big thing this morning, China fully reopened its borders this weekend. and began welcoming visitors without any quarantine restrictions after 3 years of a zero COVID policy that shielded China's population from the virus and the rest of the world. We were seeing kind of a large reaction in a few different areas, but it's also with the pledges that we're seeing from China. They're looking to really prop up what is the second largest economy, and it's some of the policies that they're going to enact over that time, the different class structures that this is also going to look to be a boon for, and for some of the businesses as well. They're looking to really remove some of the restrictions and make it more favorable of an environment for everything from tech businesses to some of the financial businesses as well. So that'll be interesting to see exactly how that nets out as well in the near future.
Yeah, I'm really fascinated to see how consumer spending comes back. Does it roar back in China? Because if that's the case, Starbucks, Nike, all these names should really have interesting and, of course, perhaps strong back half of the years. I'm looking at a good Goldman note, raising the possibility of that, in fact, happening, looking a little more optimistic for China GDP, and by extension, more optimism on China stocks. The team of Goldman thinking that the MSCI China index can rise 15% more, really, I believe, off a 30% move so far. So maybe some more gains there.
Yeah, and Alibaba is actually our top trending ticker on the Yahoo Finance platform right now. The sort of catalyst and trigger is not just the reopening more broadly, but also some specific comments from the Communist Party Secretary of the People's Bank of China, that's Guo Chuqing, who said that the campaign that China has been undergoing for what feels like a really long time now to focus on changing the internet and tech industry, that is basically done. There are just a few issues to resolve, but it has largely been closed. Now, this is something the market's been anticipating. We've seen evidence of this, that it's winding down, but this is interesting that it is official comments that are now coming. So in particular, we've been seeing a rally in tech stocks, although it has been a broader rally in Chinese stocks as of late. The real estate sector also saw some loosening of regulation. So all of that is helping lift at a time when, let's be honest, China probably needs it, right? The reopening has been quite rocky. There are a lot of concerns about the pace of growth this year. And so it looks like China is trying some different things to try and prop all of that up.
And within what they're trying, that stimulus, it's going to be interesting to see whether consumers are spending or whether they're saving some of the stimulus that is going to be put into the Chinese economy as well. Because if there's one thing that we can kind of extrapolate from how the U.S. consumer was able to work with some of the stimulus that we saw early in the throes of the COVID-19 pandemic and then the different waves of that came forward, people were using that to save for a rainy day in many instances, and then some of them using that to spend and offset where the rises in certain costs for their household were. But I think longer term, if you did see a Chinese consumer that said, you know what, we have more of a propensity to kind of save or sit on this, then that kind of counters what the entire, the intention of what the Chinese party was looking to move forward with and putting that stimulus out into the economy as well.
Maybe that U.S. consumer done shopping in Lululemon too. Just teeing it up for you guys. I'm just teeing it up. Just teeing it up.
Okay, thanks for the transition, Saz. Moving on, Lululemon shares are taking a big hit. They're down about 10% after the company revised its fourth quarter forecast, saying it expects its holiday quarter gross margins to drop as it deals with inflation and a decline in consumer spending. And it's interesting here because the company did raise its revenue forecast, raise its earnings per share forecast, but it is indeed saying that its gross margin is going to decline. Specifically, it's looking for a drop for the fourth quarter of 90 to 110 basis points. It had previously been looking for a gain of 10 to 20 basis points, and this has to do with what's going on with its costs here. Same tax rate, so nothing changing there. And so, you know, it's interesting that we're seeing the earnings forecast hold up while the gross margin forecast is not.
We made too much. You're moving through inventory and then have to mark down so much of that. Sure, that may ultimately provide some inventory alleviation and allow you to actually have more goods that you're able to work through and sell, so that churns down the inventory. But at the same time, with all those consumers that you're welcoming in and having them purchase on perhaps a lower price, that's going to compress some of those margins in the near term for sure.
Yeah, looking at Lululemon Bear, Randall Connick just out with a note over at Jefferies talking about concern about maybe Lululemon's margins have peaked, and I can't really argue with him after seeing, I would say, what a surprising quarter out of Lululemon. Strong traffic for the brand, but maybe they started to discount a little bit more, swept into that discounting, sweeping the industry, impacting a lot of companies. And we're going to talk about Macy's here in a second, but this has been a very big morning for retail pre-announcements ahead of the key ICR conference. You have Abercrombie, American Eagle out with better than expected results, Five Below, better than expected results. By and large, okay there. But again, Lululemon, not so hot. Not so hot.
No, and maybe I jinxed it, you guys. I told you guys I was at Short Hills Mall yesterday. I texted these guys and I said, take a guess at what has the longest, busiest line in the mall that I saw. And it was Lululemon. But maybe
I said Sears and Kmart.
I said Hot Topic.
You said Hot Topic.
Yeah.
We were just playing with Julie. We wanted to play around.
Yes, I know. They were messing with me. But let's talk about Macy's as well, right? Because as you said, a lot of pre-announcements ahead of ICR. Macy's got out even ahead of the game, coming out with this news on Friday, late on Friday, after the market had closed, and saying sales are going to be weaker than forecast. And you wrote all about it in your morning brief today, Saz.
What actually published on the morning brief is not actually what I wrote. I mean, I edited myself, handed in our top editors. I was very upset with Macy's doing that news dump on a Friday afternoon. Shame on CEO Jeff Jeanette. I think he could have did a better job here. You know, I hate when companies do this on a late Friday, this news dump, thinking investors are going to ignore the fact that they came out with bad news. Well, if you own a share in Macy's, best believe you're concerned. You spent the whole weekend researching this company, and you probably came up here and you're trying to figure out what should I do come the open of trading. So just a bad look here by Macy's. I hate to see it. But in terms of performance, again, another company swept into the discounting wave. You see this. I'm concerned about what Target might put up, concerned what Kohl's is going to put up shortly. Margins under pressure for retail right now.
Yeah, within this, Jeanette's saying, based on the current macroeconomic indicators and proprietary credit card data, they believe the consumer is going to continue to be pressured in 2023. That's a major headwind if you have a company as large as Macy's signaling to the entire environment that this consumer that we're going after, and we know you are as well, and we're all competing for their discretionary dollars, especially in some of the apparel, footwear categories, and even more so into the electronics, given the many departments that Macy's still tries to play in. It really comes back to how that's also going to impact some of the other companies who, whether or not they've already signaled how much this is going to be a detriment to them in the consumer mindset and that sentiment and how they're spending their dollars and where they're placing them. I think that's kind of just a shot across the industry right now and how it's going to be largely and noticeably impactful in the near term.
Absolutely, and I also mentioned in the newsletter this morning too, Macy's effectively came out here and warned for the first half of this year. It looks like they're going to be placing conservative orders for the first half, and immediately you're thinking, what does it mean for VF Corp? What does it mean for Polo Ralph Lauren? Not only these companies or these suppliers to department stores like a Macy's and Kohl's, I'll even add Under Armour in there, if they may not only have disappointing fourth quarters, but their outlooks may also be pretty bad, just going by what Macy's had to say.
One more thing I want to say is that if you look at some of the analyst coverage of Macy's here, they kind of shrugged to some extent and said, you know, we expected Macy's to be kind of bad, so it's not that shocking that it is bad. Oliver Chen, one of them, saying Macy's performed relatively better than feared, strength in occasion apparel and gift giving. A couple of things he called out. So I thought that was interesting that, well,
the inventory could have been worse. It looks like if there's any positive here, despite the sales miss, their inventory didn't balloon. But that is, I think, very much a Macy's-specific factor. For all my criticism of Macy's, they've done a good job the past 3 quarters managing their inventory.
I think the question may just pivot to what does a trade down for the consumer look like within a Macy's? Does it look like more of those homegrown brands that Macy's has authored and brought into the square footage in the retail space and the department stores? Do they start to have to kind of churn down on the amount that they're producing themselves if they're not seeing the same type of buying activity from the consumers who across other retail experiences are seeing or having to trade down in some facet or another? And so I don't know in the near term if there's a consumer shift that a Macy's will see in terms of the trade down, similar to what we'd seen in some of the other major grocery businesses or a Target or a Walmart.
Well, again, to get back to the Short Hills Mall indicator, I didn't even bother to go into Macy's.
Thanks for the gift.
All right, let's talk about. You don't want anything from there. Come on. All right, let's talk about Novavax. There's some breaking news here. CEO Stanley Erck is stepping down on January 23rd. He'll be replaced by John Jacobs, who has been the CEO and president of Harmony Biosciences. Erck has been the CEO of Novavax since 2011. He led the company through its pivot to COVID-19 focused endeavors. The stock, by the way, is down 90% over the past year. It is bouncing by 7% this morning, so it looks like investors are pleased about the change at the top. Coming up, why our next guest says both stock and bond markets are still mispriced. We'll discuss next.
Stock futures pointing higher this morning. That's following Friday's rally, although our next guest says a recession and a meaningful decline in earnings is in the offing, thus suggesting a significant drop is in the cards for the market this year. Here to discuss, we've got Matt Maley, who is the Miller Tabak Chief Market Strategist. Matt, great to speak with you as always. All right, so help break down the outlook for the rest of the year. I mean, we're beginning week 2 of the year now, so where should we expect there to be perhaps some divergence in the market? Where will things kind of continue to mirror over from 2022 even?
Yeah, I think, Brad, that we have a problem here with. So you guys were just talking about the retail situation with some of these retailers reporting some negative or outlooks. Macy's and even Lululemon, where they say, well, Jesus, just our margins, our demand's fine. Well, the demand's fine because they're lowering prices, and the demand isn't fine, I guess is my point. So they've had to lower prices. That's got demand back up. You hear what I'm saying? Is that the consumer, I think, is very much constrained. We see it with record levels of credit card debt. We see it with the savings rate back down levels we saw back in the financial crisis, and so the consumers becoming constrained, and they're 70% of our economy. So I think as we move into the new year, we're going to see these earnings forecasts come down, and with a stock market that's still, even though it's come down a lot, is still on the more expensive side of history. That's going to mean it's got to fall further.
Now, Matt, you're certainly not the only person who's saying that earnings are not going to be great, right, going into this reporting season, which really kicks off in earnest on Friday with the banks. So why hasn't it been priced in enough? If this is a hot topic, right, that earnings are going to be lousy, is it just that people don't realize just how lousy they're going to be?
I think that has a lot to do with it, Julie. I mean, it's fun. You get a little nervous when you're in the middle of the consensus. I mean, a year ago at this time, when I turned quite bearish on the stock market, there weren't that many people that were saying the same thing. Now, a lot of people are saying what I've really been saying for 6 months now, that earnings would turn down. But we also have to realize too is that these companies, at the end of the year, when they come out of their third quarter earnings reports, they don't want to give bad news at the end of the year, and they tend not to lower their prospects. But as they go into a new year, the CEOs, they like to lower the bar, and so that by the end of the year they can say they exceeded it. And so I think you're going to see a little bit more honesty, I don't know what to say, a little bit more forthright comments about their own prospects. And we're seeing that with the Macy's and some other companies recently. And of course, these layoffs, they're going to start having an impact as well. I mean, I guess my biggest point is that, the Fed started raising rates last March. It's usually about a 6 to 9 month lag. We're starting to feel the impacts of that in the economy. And at some point soon, I think people are going to come to the full realization that their earnings are going to have to come down.
Matt, you write a lot about all-time cryptos and Bitcoin. Bitcoin's been rocking the past 6 days. I'm looking at Coinbase, Riot Blockchain up nicely here in the pre-market. Is it time to get involved in here, even though the FTX fallout continues?
Well, it's difficult because it's not just FTX. Of course, we've had all these other companies that keep falling by the wayside, or at least making some big announcements, whether it be in the one of the cryptocurrencies specifically, or one of the companies, whether it be an exchange or the lenders, et cetera. That's going to cause some problem. And I'm surprised that Bitcoin and these other cryptocurrencies have held up as well as they have. So that is a bullish situation, and hopefully that means that we are coming to kind of at least the most of the bear market in the cryptos are behind us. The problem is, how much upside does it have? I just think with all this negative news out there, the real reason we saw a nice big pop at the end of the bull market was that the bull market for cryptocurrencies, that is, was because the institutions were getting involved. With all this news that's out there and still coming out there, and all the regulations we think are coming, I think it's going to be a while before Bitcoin takes off again like it did in the past. So it has many times in the past. So can you creep, dip your toe back into it? That might be fine, but I'm not backing up the truck here. I just think there's just too many uncertainties, and we're not going to see that big movement by the institutional investor anytime soon.
Matt, separately within your notes, I was reading through what you called still too much focus on inflation, not enough focus on recession. It feels like we've been talking about a recession for the past year now, but the reality of when that hits and how shallow or how mild that becomes, that certainly has also been worth the discussion as well. From your purview, what type of focus should we continuing to be placing on recession that we haven't already?
Well, I mean, I think that the people have been kind of talking about it, but again, we're not pricing it in. When people, well, I can put it this way: every single recession we've had since World War II, the stock market has gone to at least 15 times earnings. We're still at 17 times earnings. Now, to get to 15 times earnings, we got to drop down to about 3,500 on the S&P 500, and that's assuming we don't see our earnings come down at all. If the earnings stay at where they are right now, but if they drop to the 200 level on the S&P 500 or even lower, obviously that means the market will have to move lower to price in that recession. My point is, we can talk about it all the time, but I think so many investors are saying we're going to go, instead of going pricing in a recession, they're pricing into what we're going to do is we're just going to go back to what we had for the last 12, 14 years with all this Fed, largesse, with all the QE and zero interest rates. I just don't think we're going to get that. If the Fed pauses, it's not going to be a pivot. They're not going to take interest rates way down to zero, and we're not going to have QE. Therefore, we're not going to have 17 to 20 or 22 times earnings. We just can't have that unless we're getting ever-increasing amounts of liquidity. As liquidity comes down, that means valuations have to come down. I think the market has to come down. It doesn't mean I'm calling for the end of the world or a repeat of 2008. I just think we have to be a little bit more realistic.
No calls for end of the world here, Matt. It's only Monday. We got a long week ahead. Matt Meli, Miller Tabak, Chief Market Strategist. Always good to see you. Talk to you soon.
Great. Thanks a lot.
All right, coming up, Bed Bath & Beyond shares are getting a boost today after a brutal session on Friday. We'll discuss that, plus have the opening bell on Wall Street next. Welcome back to Yahoo Finance. It's ticker touching time. Shares of Bed Bath & Beyond making big moves this morning ahead of its earnings on Tuesday. Yeah, it's been interesting to watch Bed Bath shares all morning long. At one point, we're up close to 75%. I put out a story. By the time that story published on our homepage, only up 48%. So that gain losing a little steam here. But tomorrow is a big day for Bed Bath & Beyond as they report their earnings. Unclear if this will be the day where they also report bankruptcy. But again, a lot of chatter out there.
Yeah, well, a lot of that chatter, of course, emanating from the announcement late last week. And really, this question mark of when and if they will declare bankruptcy, largely, I think, expected at this point, considering some of the red flags that they did raise within their own statement that they put out saying, hey, yeah, we have a clear vision for the future of the company, but then went through all the details of how murky things are right now and how the business might not survive.
If you do not have the cash, you could have a great vision. I mean, you can't execute it if the stores aren't open. So, yeah, there's that.
Yeah, I don't know what else to say about this thing. We're just going to keep watching it until something happens.
Yeah, our very own Alexandra Somonova tweeted me a good photo. She went to, I believe, a Bed Bath store in Lincoln Center. I tweeted it out this morning, and the shelves are empty. And when you see that at a retailer, that is a great sign that a struggling retailer is having, there's a lot of concern about vendors getting paid. Now the shelves get empty, they lose more customers, they go elsewhere, the chain continues to struggle.
Yeah, saying we have a clear vision for the future of the company in paragraph 2 of last week's statement, and then in the final paragraph saying we're considering all strategic alternatives, including restructuring or refinancing debt, seeking additional debt, and then you go all the way to the bottom, obtaining relief under the U.S. bankruptcy code.
I wish them well.
Okay, let's talk about something else. Let's talk about the Dow stocks are rallying this morning into the open. It looks like futures are pointing to a higher open ahead of this busy week, and it's intriguing because we had a big gain on Friday. We have gains today. And this is ahead of a week that we don't know. I mean, we're going to talk about this more later, but we've got CPI this week, which, yes, might show a little more relief on the inflation front. Then we've got bank earnings teed up for Friday, and it feels like investors are sort of bracing themselves. You know, we just talked to Matt Maley about that, and yet we've got stocks that are trading.
Yeah, Big Jerome Powell had a briefing tomorrow.
Yes, he's speaking at the Reichsbank tomorrow, tomorrow morning. So, you know, we'll see what he has to say. Presumably he's seen the inflation data already. Maybe he hasn't.
Maybe he'll share some views on Bed Bath & Beyond. I don't know. Unclear. I'm very excited. I can't wait to tune in.
I think that's pretty clear.
Maybe he's running his own calculations.
Yeah, right.
On the inflation
and price target zero.
Something tells me Jay Powell is not now, nor has ever been, a Bed Bath & Beyond shopper. I could be wrong.
Or sends his assistant.
He loves those towels.
Yes. Exactly. All right, here is the opening bell on this Monday morning. A lot of ladies up there on the podium this morning, which you'll love to see. I think it's all ladies up there on the podium, which is great stuff. So we've got the opening bell this morning, again, ahead of this busy week and after the first winning week for stocks that we have seen since November. So a little bit more of an upswing despite the perhaps pessimism that we are hearing from investors for this year. All three major averages right now opening up, Brad.
Yeah, they are. All right, we're in the green. Dow Jones Industrial Average off into the races to the tune of about 0.25%. So it's higher here in the early moments of trade by about 90-ish points. Nasdaq Composite, you're seeing that add on to gains from last week. Over the past 5 days, we're net higher by about 1.9%. Nasdaq Composite up 0.9% out of the gate this morning. And then additionally, the S&P 500, you're seeing gains there to the tune of about 0.5%, nearly 2% over the past 5 days here. Let's also check in on some of the S&P 500 sectors, 11 sectors. We've got most of them in the green here to start off the day. We're led, by consumer discretionary. As of right now, that's up. Let's populate this chart for you. We'll give you a 5-day view. Why not? We're up by about 3.5%, 3.6% over the past 5 days. But here today, out of the gate, higher and leading the charge by about 1.3%. You've got energy and technology also following suit there. But then one of the major laggards that we're seeing here on the day, we're seeing consumer staples. That's actually down by about 0.2%. You've also got utilities helping pull up the caboose here. So we'll continue to keep a close eye on that. Also did want to take a look at some of the pharmacy benefits managers as well, because we've seen a little bit of an executive changeover that's taking place at Rite Aid. Let me see if we can get them up on this screen here. All right, I'm not seeing them on this one. However, we've got a good look at CVS here as well this morning, and that's down by about 0.7%. That Rite Aid changeover that I mentioned, coming at the top, there's going to be a new interim CEO, goes by the nickname Busy. So hopefully Rite Aid getting busy with the new CEO in the best way, and ultimately,
My nickname is Brian right, hyperactive Sazi. Julie, you got what? You want to create one on the fly for you? No? Okay. All right.
I put mine in Slack already.
I know you did.
Brad a la mode Smith.
Oh, that's what that was in response to.
That's when I got.
Always put the ice cream on top.
7:45 a.m.
Okay.
I was working with.
I don't know. Chico's is out with its holiday sales, reporting total net sales growth of 4.9% over the last year during the 9-week holiday period, but the retailer slashing its outlook for the fourth quarter. This again falls into the category of companies coming out ahead of this ICR conference with various announcements.
Soft quarter for Chico's White House black market segment. And I will sum this up. I've been actually in some of these stores more recently, White House black market. I just want them, obviously I'm not the target demo for this, but stop putting sparkles on everything. Everything does not need sparkles.
Why not?
Does Chico's stuff have sparkles?
It's out of control. Everything, they take basic apparel now and they're cranking it up to make everything shiny and sparkly. And some of these products looks like they won't even make it through a wash, and the prices keep going up.
Wait.
Yes.
I guess I'm just a little confused why you know so much about Chico's and what they're selling.
We'll take
right
that.
now?
We'll take that off air. But I've been in these stores a lot over the past month and a half, and I just know a lot about Chico's. I go into Chico's. I buy gifts for people inside of Chico's, and they like it. But still, I think the products have gotten too fashion forward, and the quality has not kept pace. Hence, you're seeing, I think, some soft traffic here. The price is very expensive here, very expensive.
I will give you an out, because over the past, 2 months, as you're doing a lot of shopping for others over the holidays, perhaps you tend to find yourself meandering into or being part of the foot traffic in stores typically you wouldn't go into. So I understand that. However, I think what Chico's is saying about some of their total net sales and what they've seen over the last year, up 4.9%, comp sales up 5.3%. They're saying that sales have remained healthy and sales continue to improve at their Soma division as well. But the White House black market sales, those continuing to soften or softening right now, that continues to be, I think, one of the larger question marks to see where they will see that rebound, especially at a time where people were looking to, as evidenced by Banana Republic, get back into some of the fashion categories that would get them back into or be ready for some of the social constructs that we were mentioning.
It's interesting to hear Sas talk about the quality, because I definitely have noticed, and I tweeted about this last week, that yes, you might be getting bargains at certain places, but there is definitely a decrease in quality.
Yes.
Even from higher end brands, that you would get a pair of wool pants that would not be lined any longer is just mind-blowing to me and unfortunate. I recently bought a pair of pants at Banana Republic that were not lined, that should be. And then there's another pair of pants. Again, I'm doing a lot of anecdata today. I'm doing a lot of anecdata. Here, I want to tell you one more thing. So I looked in a J. Crew also for a pair of pants at the mall. This is, I don't go shopping at the mall very often, but when I do, I have a lot to share with you.
This was
I went to J. Crew. I have found a pair of pants I liked, but I didn't want to wait in line. There was a long line, so I said, I'm going to order them online. Yeah. I go online to look at the same pants, reading the reviews, as one does. A bunch of people say they got this pair of pants. One leg was shorter than the other when they received them. More than one person reported that this happened. Again, quality control and retailers trying to cut corners right now. It's kind of amazing.
It's getting worse, and where they're cutting the corners is on buttons and zippers you feel in. I have to, look, I love North Face.
Do not give me the plastic, like the cheapy looking plastic
I love
buttons.
North Face, and they are known for their black tech fleeces, but I picked one up at Dick's Sporting Goods recently, and the name North Face used to be sewed onto this fleece. It is now, I don't know.
Hot glue gunned?
Yes, hot glue gunned, and the zipper is borderline plastic, and the price is higher. I'm upset with North Face. When you have a premium brand like that, you expect the same experience you've been getting for the past 10 years. I think they could have better. I would pay more. Just leave the damn product alone. Don't ruin my zippers on a product I come to you every 5 years for.
Wow, we're both fired up on the same subject.
Yeah, but both legs have to be the same. That's one cost. That's one cost you don't want to make, Julie. Wow.
Yes.
I think you guys got to start shopping at Hot Topic like me a little bit more, because everything is an upside surprise after that.
I didn't even know Hot Topic was still around.
They're around.
Yeah. We're also tracking shares of Oracle.
Are we?
They are ORCL on the day. They are higher by about 1.4% after Piper Sandler, who is tracking Oracle, they upgraded the tech company to overweight from neutral, citing Oracle's cloud business, and they're expecting it could see annual growth above 20% in the coming years. What Oracle had kind of called out or shouted out in its most recent earnings call was that the gross margin for cloud services, license support, 79%, of the mix between support and cloud. Oracle license support revenue as well. That continues to hit some of those mid-90s margins. I think all in, this is a category that they're continuing to update investors about because they know the growth strength, the growth propensity that this has in the near term. But there is that license or seat count compression that continues to be one of the overhang or looming clouds over the broader cloud industry.
Clouds over clouds. Yeah. You know, Oracle recently got that government contract, right? That had been Oracle has been and also ran in cloud, even though it's huge, right? But just compared with the top leaders in the industry, and it seems to be slowly chipping away at that and gaining a little strength. And this is something that Brent Bracelin, the analyst here at Piper Sandler, points out, that cloud, the transformation to cloud could be more durable than investors expect. And he also says Oracle Cloud revenue will eclipse database revenue by fiscal 2025, which would be a big deal for Oracle, which has been the database company, right? So it'll be interesting. He says this is going to be a watershed year. We'll see if that ends up being the case here, but it looks like the price target is set to 104 over Piper Sandler.
Yeah, this turnaround at Oracle has really been not talked about enough. Of course, you have Amazon, Microsoft, Salesforce in this cloud mix as well, but the past 4 quarters in the cloud business for Oracle, I believe sales have accelerated every single quarter into the economic slowdown. I mean, the company is gaining share. I think if you just go read the financial statements, you're not surprised by this upgrade.
And it's come on the back of some of their strategic acquisitions that they've made too, whether that be in the marketing cloud, and you could take that back almost 10 years at this point, making the strategic acquisition of Eloqua, and then even more recently, the Cerner acquisition too. That one that really caught a lot of investors' attention, and they continue to kind of provide some updates around. But I think that acquire to growth strategy has just frankly worked for them. They've made very strategic and well-rounded acquisitions that are immediately accretive to the business, and if not immediately, at least they are very transparent about that timeline as to when it will be a boom for the business, and I think that transparency has helped them out a lot as well in the street. Also coming up on the other side of this short break, Yahoo Finance and Nesfray is going to break down the latest market action after last week's rally. That's next. Welcome back to Yahoo Finance Live this morning. We're about 11 minutes into today's trading session. Let's get on over to the Wi-Fi Interactive, where Yahoo Finance's own Inez Ferrer is standing by. Hey, Inez.
Hey, guys. Yeah, and adding to gains that we saw last week as well. Looking at the Dow right now, up about 0.4%. The Nasdaq also higher, up 0.8%. Consumer discretionary leading the gains. I do want to point out the U.S. dollar index. I'm going to pull up a 5-day chart so you can see here. This is the U.S. dollar against a basket of currencies. Last Friday, before that jobs report, it was just above 105.6, and right now it's at 103.3. So this downward pressure on the dollar index, that is also helping to support equities right now. And as I mentioned, consumer discretionary leading, also communication services, energy stocks, those are leading the gains as well. Over on the Nasdaq 100, we're looking at some of the mega caps that are in the green. We also are watching the semiconductors, seeing a nice pop today, as well as the Chinese ADRs. Do want to mention what's happening with crypto, because we've been watching Bitcoin up for a 6th straight session. Remember that Bitcoin trades at a 24-hour pace, so 24/7, and you're looking at Bitcoin right now at just above 17,200 per token. And over on the crypto-related stocks, we've been watching Coinbase up more than 7%. Coinbase was initiated at Jefferies with a hold with the analysts there, talking about the FTX debacle and how that really is negative for Coinbase, and trading volumes will suffer. But the analysts pointing a couple of good points about Coinbase, one being the company's premium brand, the scalability, and also the healthy balance sheet that should help Coinbase weather the storm that we're watching in crypto right now, guys.
Inez Ferrer crushing it at the Wi-Fi Interactive. We'll see you soon. All right, last, some good news for consumers on the inflation front. Crude oil prices have dropped about 29% from their peak last year, which happened around the start of the Russia-Ukraine war. Meantime, the UN Food and Agriculture World Food Price Index has dropped for 8 consecutive months. Coming up, Tesla stock has had a rough go of it so far this year. Is there any relief in sight? We'll discuss next.
Tesla has faced steep declines in the past year. We've talked a lot about it. It's down over 60%. Our next guest says, while the stock is oversold, the bottom has perhaps not yet come. Fundstrat Global Advisors Managing Director Mark Newton joins us now. Mark, good to talk to you. It's been a while. So talk to us about what you're seeing in the charts here that leads you to believe perhaps there's some more downside for Tesla.
Well, I think if anything, one should look at it from the opposite perspective, is that why should there be a bottom when a stock has been down over 60% in just the last 3.5, 4 months? I think, as we approach a new year, everybody always likes to say, well, it's oversold and therefore we can just step in and immediately expect mean reversion. But, technical analysis doesn't really work that way. And anything, if 2022 has taught us anything, it's that it's almost a fallacy to expect that we can just run in and buy our favorite names just because they're down substantially when we're still within a bear market. So yes, Tesla is now officially oversold. We're getting closer to targets that I think are meaningful. But, a few months ago, I did a number of different interviews and we took a look at cycles and counter trend exhaustion techniques and a lot of things that people like myself using technical analysis like to do. And, at the time, it broke $206 back in early November. That's when Musk was selling shares. And that indicated this break of a giant head and shoulders pattern should start to lead the stock lower. Volume expanded on that, really confirming the breakdown. And so, I'm looking right down under $100 right before Tesla's earnings happen, right towards the end of the month. And that's when a lot of my own cycles start to show the chance for a bottom. We could bottom and start to rally into the spring. But, I think just looking at a few point bounce today, it's up, I think at 119 already. Still difficult for me from a momentum standpoint to think that lows are in and also from a cyclical standpoint. So my work is not lining up just yet.
Mark, what is counter trend exhaustive analysis and how does that apply to Tesla right now?
Well, it's one of the tools in my in my toolkit. I look at the work of Tom DeMark indicators for evidence of exhaustion, not only of uptrends, but downtrends. And I use them amongst many different time frames and on many different indices and stocks. And so those are helpful to be able to buy dips within downtrends and also to sell when something is reaching a possible peak. And so looking at a weekly chart of Tesla, it's simply early by about 2 weeks right now to think that there's a potential low. So that's why I looked at when Tesla's earnings were, and that all of those line up towards the latter part of January. So it makes a little more sense for me that initially this little bounce might be sold, but pulling back over the next couple of weeks would offer some opportunity for traders that might be looking to time better entries.
Mark, I asked this from a place of intrigue and not from a place of pushback, but isn't Elon Musk a bit of an anomaly when it comes to some of the traditional ways to apply technical analysis, given the strength and just velocity of selling that he was doing so that he could finance buying another company?
Well, if anything, as I've been trying to talk to investors about over the last 25, 30 years, it's really important to take the blindfold off and realize that all this news or an outside influence, somebody like Musk really has very little to do as to how a stock can move on a day-to-day basis. Many people, as you remember, doubted Tesla literally all the way up as it was moving higher. And even on the first pullback now, now everybody's on board and believes Tesla. And as it's falling, they're all trying to say what the stock is bottoming, and it's clearly a buy because it's undervalued. Look, that's human nature. We all want to buy low and sell high. If anything, my work suggests that it's almost always better to concentrate on those stocks that are hitting new all-time high territory versus looking to buy dips when the market is still within a bear market. So, to answer your question, I don't know that Musk is necessarily, everybody thinks now that he's distracted or that supply and demand is slowing, supply is up, and those are reasons maybe not to buy. And so, you can actually take those fundamentals along with the technicals and say that it's probably still a little bit early to think that Tesla, has made a bottom.
One of the other, just to dig a little bit more into your analysis of Tesla specifically, Mark, I know you're looking at cycle analysis also, and we have a chart of that from your note. Can you sort of explain, as much as you can in layman's terms, sort of explain that to us? And you also mentioned that Tesla might not bottom in the near term, but it sounds like further out, you think maybe it could. When will you have sort of the information you need to determine that?
Well, initially, I'll put more weight on oversold conditions and the market indicators potentially signaling a buy by the end of the month. But a lot of the cycles, the most accurate one for Tesla over the last year is just the 107 trading day cycle. It occurs about once every 5.5 months. If you look back, it's pinpointed almost every major peak and trough in Tesla over the last year. So until that shows some evidence of not working, my thinking is that we're likely to see a bounce, but then I think we probably are going to show further weakness into the months of April, May before we really truly bottom. And I think I can say the same about the US stock market as well. So, what I did was just take a cycle composite, and it's through the foundation of the study of cycles, they provide tools where one can look at highs and lows over the last 5, 10 years, 15 years, 20 years, and really create, a composite to really show you how a stock and or an index might have the potential to bottom or peak out. And so that's one part of the analysis, but I do find it quite useful.
Your stuff is very interesting, Mark, and it's good to catch up with you about what's going on with Tesla specifically. We'll broaden it out next time and talk more about the broader market. Fundstrat Global Advisors Managing Director and Global Head of Technical Strategy, Mark Newton. Thanks, Mark.
Thank you. Happy New Year to all.
You too. Coming up, earnings season is closely approaching. Saz is going to share his take on how investors should prepare next. Analysts are gearing up for a tough earnings season as the economy has slowed and inflation remains stubborn. You can see their concern through changes to earnings estimates. This is something we've been talking about all day. I suspect we're going to continue to talk about it as well.
Yeah, so I'm tracking earnings estimates. Of course, the team at FactSet puts a lot of this work out. Hats to them. I know it's a lot, especially going into an earnings season. So a couple things I'm watching here. First, earnings estimates are sliding more than historical averages, according to data compiled by FactSet. They're noting that from September 30th to December 31st, S&P 500 earnings estimates for the fourth quarter have been cut by were cut by 6.5%. During the past 5 years, the average decline in earnings estimates during a quarter has been 2.5%. Looking out over 20 years, The average decline in earnings estimates during quarter has been 3.8%. So what does it mean? It essentially means that analysts are growing a little more concern on how that fourth quarter will play out, a little bit more than history, as we potentially go into a recession at some point this year. Again, wildly unclear. Now, where are some of the biggest cuts coming sector-wise in the S&P 500? In order of biggest cuts, materials are seeing a lot of cuts. Consumer discretionary, the second on this list, no surprise there. We're seeing some warnings out this morning, of course, from Macy's and Lululemon, so analysts very concerned about that. And then communications as well, also seeing a large amount of earnings cuts. Now, there are some positives here, maybe not totally surprising. Energy. Now, energy was one of the top performing sectors last year in the S&P 500 as oil prices rose. So analysts still very bullish on the profit expectations or potential for energy plays. Also utilities getting some earnings upward boosts by analysts. Now, we're also looking at this chart as well as we look towards what may happen for the rest of this year. Earnings estimates for this year are also starting to fall. You can see that downtrend there that really began in early November, and it continues. I would bring up that perhaps it has not fallen enough, given what we are seeing out of some of these retailers out here this morning. But nonetheless, that downtrend is well intact for S&P 500 earnings estimates. Overall, my take is this: as I just been mentioning on a lot of these retail names, our earnings estimates, the cuts we have seen, really kitchen sink enough. Fab artwork by our team there. That is me in the kitchen looking for declining earnings estimates going right down the drain. We're seeing just the fact that you see a Macy's, you see a Lululemon warning on profit estimates and sales suggests there could be a lot more misses out there, and maybe analysts have not taken estimates down enough, and maybe we will see more volatile stock trading like we're seeing in a Lululemon today.
Well, even when we hear more about what the health of the consumer is from the banks that report this week and start to get some insight into how they're looking at everything from debt to balances in some of their client accounts as well. And then just the type of spending that they're doing. We did see an upgrade this morning from KeyBank on Visa and MasterCard, which would actually tell you that they're doing a little bit more leaning perhaps into some of those credit services in this near term as well. And that perhaps there's strength for Visa and MasterCard, but the way that consumers are spending right now and the health of consumers is certainly now not even just moderating. There is this declining capacity in mind in terms of the sentiment and how much they're going to continue to spend in some of the discretionary categories.
And a little nugget real quickly, the JP Morgan team, Matt Boss, the longtime retail analyst there, met with Macy's after they put out this guidance. He noted that when they talked, they called out rising delinquencies on credit cards. So just a little nugget to pack away ahead of those bank earnings. I'm a little surprised with that Visa and MasterCard upgrade, but just something to watch as we get through the
another
week.
thing to watch, loan loss provisions, right? And credit loss provisions as well in those bank earnings.
Absolutely. A lot to keep close tabs on here. We will for you and bring it your way. Coming up, though, Rolls-Royce speeding into the new year with record sales. We're going to speak with the CEO. That's next.
Welcome back to Yahoo Finance. I'm Brian Sazi here with Julie Hyman and Brad Smith. We're seeing some mixed action as traders continue to digest last week's jobs report while also looking toward earnings from JP Morgan, Citigroup, and Bank of America later this week. Right now, all three indices really have strengthened since the opening bell on Wall Street. Dow leading the way up about 140 points. Here's what's on tap this hour. We finally have a House Speaker. Now, finance contributor Kevin Cirilli digs into what Kevin McCarthy's time as House Speaker may look like. And weak stock prices hasn't slowed down Rolls-Royce. We'll speak to the CEO of Rolls-Royce on the back of a strong stretch of sales. And putting a hold on dry January, Constellation Brands and CEO Bill Newlands stops by after the maker of Corona cut its outlook, citing the impact of inflation. Brad, over to you.
All right, thanks so much, Saz. Well, as you mentioned, the major averages holding on to gains earlier here today in trading. We're up by about 0.4% on the Dow Jones Industrial Average 33 minutes into today's session. And then the Nasdaq Composite, you've also got that higher here intraday, ripping to the upside, though, by about 1.7%. We'll keep close tabs on that, but that adding on to the last week's gains that we had seen. So over the past 5 days, in aggregate, higher by about 2.7%. S&P 500, that's up about 1% as well. Let's take a look at some of the sector activity just to see what's continuing to transpire here early this morning. And we've now got even more of the 11 S&P 500 sectors in positive territory. It looks like just 2 laggards here on the day. We're led right now by technology and consumer discretionary technology, as we were seeing there on the Nasdaq, and that reflecting that tech move to the upside for the tech heavy average there. Technology select ETF, you're seeing that higher by about 2.25%. And then additionally here for XLY, consumer discretionary, that's up by about 2%. Want to take a brief look at the Nasdaq Composite as well. For those mega cap tech stocks here on the day, take a look at Apple, Amazon, Microsoft, Google, all having strong openings to the week here. For Apple, up a little more than 2%. Amazon seeing gains of 3.6%. And then even on the chip maker front, and we'll get into this just a little bit more later on, NVIDIA, you're seeing that higher by about 6.7%. Also joining in full force, you've got Microsoft, Google, and Meta in positive territory. So we'll continue to keep a close eye on that. Well, switching gears, if you will, luxury automaker Rolls-Royce saw strong demand across their entire product portfolio in 2022, and it led to an 8% increase in sales compared to 2021. Joining us now to discuss the strong year, we've got Rolls-Royce CEO Torsten Muyer-Echvos, who is joining us this morning, as well as Yahoo Finance's Pras Subramanian. Great to hear about some of the strength that you had seen, and really on the back of a different kind of consumer that Rolls-Royce typically goes after. So what are you seeing in terms of that consumer, and how are you kind of continuing to power through some of the orders that you may be receiving?
I mean, first of all, good morning. Yeah, we had a fabulous year last year, and for the first time ever breaking through 6,000 cars worldwide. But I think even more important than volume is probably the price position we achieved worldwide. On average, 500,000 a Rolls-Royce goes now for, and that is quite an achievement. That was 10 years ago on 250,000, so quite a substantial higher positioning of the brand. The clients themselves became even younger last year, so we are now on an average age of 42. We are even younger than a brand like Mini, for instance, and I've seen, particularly from the younger ones, what I call fantastic bespoke commissions that were created here together with our design team. So I must say we have seen also record levels on the bespoke side. So all in all, a brilliant year. And not to forget, the car behind me, Spectre, we unveiled Spectre, the very first high-end luxury car, full electric.
Hey, Torsten, Pras here. Congrats on the strong 2022. I'm just curious about the luxury consumer that you guys are working with these days. And are you seeing any slowdown in their uptake as we sort of enter 2023? Or is it just Rolls-Royce buyers are just wanting to buy more cars? It doesn't matter what the macro settings are.
Yeah, we are. Plus, we are quite fortunate because we sit on a strong order bank that already goes far into 2023. Probably around 8 to 9 months, and more to come. We haven't seen a slowdown yet. Let's see how it plays out over the course of the next 2 or 3 months. I wouldn't say that we are completely immune against any recessionary tendencies, because you know it anyhow that 80% of our clientele is business savvy. They run their own businesses, captains of industries. So when their own company is suffering, then also maybe the appetite might slow down to be seen in a new Rolls-Royce. But I think all in all, very strong sentiment currently, what I sense all over the world. Funny enough, also China obviously was slightly dented last year by COVID, but only slightly. They even produced the second best ever year in history, which is quite a remarkable achievement by the team over there, given all the circumstances the country was in.
Torsten, does your customer, I guess that 42-year-old that you just mentioned, do they really want to see your brand making electric cars?
Definitely, definitely. I think we are the ones who aren't defined by roaring exhaust noises or loud engines. We are silent. And silent propulsion, magic carpet ride, is what Rolls-Royce is all about. And going electric delivers an even more remarkable magic carpet feeling. I mean, I had the pleasure to drive Spectre already quite some miles, and I can tell you it's stunning. One important thing always is it's a Rolls-Royce first and an electric car second. Very important for our clients. We have shown the car already to quite a lot of clients worldwide. The order book is very strong, even exceeding our expectations. So for that reason, I'm very confident that we hit the nail here on the head with that car. And I'm also very confident in our strategy that we will go further electric, and that by the end of 2030, we are completely electrified. We will see a complete electrified portfolio of Rolls-Royces worldwide.
Hey, Torsten, so with that Spectre, are you seeing a younger mix of buyers for that car? And also, are you guys set for later this year for the production of the car and deliveries?
I mean, it's difficult to become even younger now, knowing already that on average we are 42, 43. We are seeing quite some similar kind of age structures in our Spectre pre-orders. Funny enough, there are also quite a lot of clients we haven't seen ever before. Clients who are coming for the very first time to us for the reasons that this Spectre is fully electric. And that is very compelling. And it is also compelling in a way that in the super luxury segment, we will be the only ones also for the next coming years who can offer a full electric car. And I think that resonates extremely well with some clienteles who are fond to be seen only in electric cars.
Even within the consumer environment right now, as you kind of look across the global economy and get a sense of how your business can weather a recession and where you will need to continue to kind of, like other businesses, look across the cost structure that you do have right now. Have you needed to kind of implement a playbook, even at Rolls-Royce, despite you having a more affluent consumer, some type of recessionary playbook?
I mean, we always were extremely cautious in ramping up fixed costs, for instance, or installing expensive structures. I mean, I said it already, this business isn't immune against any recessionary tendencies, and it's a quite volatile business. So we might even see years where we even see a drop compared to the previous year. That can happen. That shouldn't be a worry at all, because it will come back. My clear conviction is that structures need to be lean, because I always want to be profitable. So our break even is very low, and for very good reasons. And I think that's the way also to steer a luxury brand, to make that luxury brand, I would call it, immune against certain fluctuations in the market. You also need to look for a proper global picture in your sales structure worldwide, because not every market tanks immediately. Others go even up, others go down. So you need to have that global balanced picture, and that will give you certain stability over time. And that's exactly what we have achieved. And so for that reason, I'm quite confident. I call it myself cautiously optimistic about the outlook for 2023 and definitely also for 2024, because 2024, Spectre comes into full play and will form, I call it, the third column between Cullinan, Ghost, and then Spectre.
Well, I wish you well on the year ahead. Torsten Müller-Eschvos, Rolls-Royce
Thanks a lot.
CEO. Thanks for the time today, as well as Yahoo Finance Senior Auto Correspondent Praz Subramanian. All right, from cars to the economic and market outlook. With inflation data and bank earnings coming this week, we now welcome in Yahoo Finance's Alexandra Semenova on what we can expect to see in the week ahead. Alex, very, very busy week. We have some Jerome Powell. He will be speaking tomorrow, but of course, all eyes on bank earnings on Friday.
Indeed, Brian, the market's climb higher will be put to the test this week with a bunch of potentially market-moving events. We have the CPI report on Thursday, which is arguably the most important economic release of the month. Federal Reserve Chair Jerome Powell is slated to speak in Sweden tomorrow at a symposium hosted by the central bank. And on Friday, JP Morgan will report earnings along with some of its banking peers, Citibank, Bank of America, and Wells Fargo. Now, on Thursday, December's consumer price index is expected to show another slowdown in inflation. Estimates have the headline figure at 6.6% and core CPI at 5.7%. And this report is likely to dictate bets on whether the Federal Reserve will raise interest rates by 25 basis points or 50 basis points February 1st at its next decision delivery. Because so far, the reports that we've gotten have kind of been a mixed bag. The jobs report, manufacturing data kind of haven't given much clarity on what rate hike they'll go with, but CPI could provide some more insight into that. And then, of course, on Friday, JP Morgan, the largest consumer bank in the U.S., will lead earnings results. Banks typically benefit from higher interest rates because it boosts their net interest income, or the spread between the money that they make on lending activity and what they pay out to depositors. But that has been different this time around because challenging market conditions have dealt a blow to deal-making activities, which have offset that net interest income increase that they've seen. Things to look out for in bank earnings will be a drop-off in equity underwriting with a slower IPO activity, a drop-off in deal-making revenues, more potential layoff warnings. We have Goldman Sachs laying off people starting this week. And then loan loss provisions, or how much money banks are setting aside for potentially sour loans. And then, of course, a look at the U.S. consumer. Jamie Dimon is always quite vocal about this. He's been talking about a consumer-led recession, especially as inflation has eroded away the earnings that people have accumulated during the pandemic. At the height of this was $2.1 trillion at the beginning of 2020, I believe. And now we're down below $1 trillion. So we're really seeing consumer spending really wipe away their earnings.
And we're also seeing the effect on a bank that has not traditionally had a big consumer business. That's Goldman Sachs, which we're learning is going to be cutting some jobs.
Exactly. Goldman Sachs is expected to start layoffs this week, laying off more than 3,000 workers. And the important thing here is the bank typically weeds out underperforming bankers at the end of the year. It culls about 1% to 2% of its workforce. It paused this during the pandemic and brought back those performance reviews last year. However, this goes far beyond the culling. It is really cutting costs wherever it can. This is another sector like tech that has overhired during the pandemic and now has to let go of some of those people. The interesting thing, too, is it has been the most vocal among banks about layoffs. JP Morgan, Bank of America have said that they're not laying off bankers just yet. So it'll be interesting to see from the earnings whether that changes at all.
Alexandra Semenova, thanks so much. Appreciate it.
Thank you, guys.
All right, Citigroup analyst Itay McCallie is feeling shares of General Motors into earnings in just a few weeks. Says the analyst, we continue to like the GM setup. With GM having exited the fourth quarter showing favorable U.S. market share momentum, we see less risk of management adopting a materially different outlook versus its November investor day. Coming up, political unrest escalates in Brazil. Julia's back with more on that and other top headlines next.
Here's a check on some other headlines we're watching. AstraZeneca is boosting its footing in the market for heart and kidney drugs with a $1.8 billion acquisition of Syncor Pharma. The move bolsters the second most important segment in AstraZeneca's business after cancer drugs. Its heart, kidney, and diabetes medicines generated almost $7 billion of revenue over the first 3 quarters of 2022. And shares in the clinical stage biotech surging 137% on that announcement. Hundreds of people have been arrested after supporters of Brazil's former president, Jair Bolsonaro, invaded the nation's Congress. The uprising lasted around 3 hours, with the protesters smashing windows in the presidential palace and even attempting to flood parts of the chamber. The violence comes just days after the inauguration of leftist President Lula da Silva and amid claims from the former far-right leader of election fraud. There are currently no reports of deaths or serious injuries. And President Biden has visited the U.S.-Mexico border for the first time since taking office. The nearly 4-hour visit to El Paso began with a tense handshake with Texas Governor Greg Abbott. Greeting him moments after stepping off of Air Force One, Abbott handed Biden a letter heavily criticizing his border policy. GOP lawmakers have pounced on a reported surge in crossings in recent months. And in December, the Supreme Court extended the controversial Title 42 policy, allowing authorities to expel migrants on public health grounds. Biden, by the way, now heads to Mexico City for a summit of North American leaders. Saz?
We finally have a Speaker of the House after several days of high drama. Yahoo Finance contributor Kevin Cirilli is here with more on this. Kevin.
Well, Speaker McCarthy now faces his first test as early as in just a couple of hours if he can get the Republican caucus to align on a rules package. Now, this essentially are the rules of the road, the guiding principles that will allow for Congress to operate. And quite frankly, he can only lose 4 votes. And if the past couple of days are any indication, it's been a rough start for Speaker McCarthy in keeping the Republican caucus in line. But there's been a fascinating division that's emerged within the ranks of Republicans. You have far-right conservatives led by the likes of people like Congressman Matt Gaetz, and then other more center-right conservatives like Congresswoman Nancy Mace, a rising Republican star who has come out and said that she would vote against the rules package, she's undecided, if it includes cuts to defense spending. So more moderate Republicans are really increasingly concerned about the deal that Speaker McCarthy made with right-wingers in order to get the gavel. And it could have long-lasting implications well into this summer and early fall once the U.S. has to raise the debt ceiling. Remember, ultra-conservatives have been pushing for quite some time that there be cut to entitlements, as well as cuts to some government funding agencies like the IRS. And that could lead to a very volatile couple of months in Washington, D.C., especially around the timing of the debt ceiling.
Speaking of volatile, there's also the relationship between President Biden and Republicans, I guess. I was just talking about President Biden's first trip to the U.S.-Mexico border, the confrontation between he and Texas Governor Greg Abbott. Talk to us more about that meeting and sort of the implications as well.
Well, Julie, border security and border control, and as well as the spread of fentanyl across the United States, are just some of the agenda items for President Biden as he meets with Mexico's president. And in addition to that, he's also going to be joined by Canadian Prime Minister Justin Trudeau. Now, the 3 global leaders are going to talk about, in addition to drug enforcement, in addition to immigration issues, also access to credit in some of the export credit agencies and international development agencies that Mexico would like to see. Remember, the United States, Mexico, and Canada have had a pretty interesting go of trade negotiations in the last couple of years. But when you start talking about energy and electric vehicles and where parts are manufactured, these 3 nations they're not on the same page as it relates to trade. And then the last point about President Biden's trip is that it's not happening in Mexico, but what the events in Brazil have really added a new level of dynamics to President Biden's visit. because this is very much reminiscent of what happened on January 6th. Vice President Kamala Harris will be swearing in the new Brazilian ambassador later this week. It's expected that the administration will continue to speak out against what happened in Brazil, but look to see if any Republicans on Capitol Hill also denounce that criticism, or denounce that violence as well.
And Kevin, while we have you, more in international relations, Japanese delegation visiting the White House at the end of the week. What do we know?
Well, Japanese Prime Minister Kishida is going to be meeting with President Biden at the end of this week once the president returns back to Washington, D.C. It comes as the new Japanese Prime Minister has traveled to other countries in Europe as well as the UK, trying to continue to strengthen security support in the Indo-Pacific region. Look for security to be front and center between President Biden and the Japanese Prime Minister.
Yahoo Finance contributor Kevin Cirilli. Kevin, good to see you this morning. Thanks for breaking that all down.
Thank you.
Coming up, everyone, we're going to share Ali Garfinkel's interview with the CEO of AARP from CES. That's coming up next. It was a big week in the tech world as everyone combined at CES, and Yahoo Finance's Ali Garfinkel got a front row seat at CES in Las Vegas. She had the chance to speak with AARP CEO Joanne Jenkins on the company's age tech collaborative and the future of its technology. Take a listen.
The AARP Age Tech Collaborative is really our take on how do we bring startup technologies with investors, with our knowledge at AARP of the kind of solutions we need that will allow people to live and age better. And so we all know that people are living much longer than they did for our parents or grandparents. And so how do we make that as exciting and healthy and painless as possible? And all of the companies that you see here in the H-Tech Collaborative are part of that venture with us.
And the H-Tech Collaborative is pretty new, right? It was just established in 2021, I believe.
Started in 2021, but building off of several years of our space in the innovation space of really trying to help solve issues, particularly around health and financial, and also addressing issues of isolation. And so you'll see a lot of the technologies and solutions that are being developed focused in those areas.
So I'd love to hear, I was with a couple of the startups you guys have invested in, Flowly, Labrador, they're all really cool, but I'd love to hear what technologies you're most excited about right now.
Well, I think one of the things that I love to see is the technologies related to solving issues around caregiving. I often say that one thing's for sure, you're either going to need a caregiver or be a caregiver, and to see the kind of technologies that allow caregivers to be in another state and coordinate and collaborate with someone, a patient or either their parent or grandparent in their own home, I think is so helpful. We see that also helpful to doctors and healthcare providers being able to communicate with the person to make sure that they're keeping up with their medicines, whether it's around medication management or fall prevention. So many of the different technologies you see. And what's so interesting to me is most of the innovators here, they're solving something for either a parent or grandparent. So it's a real personal touch, while at the same time coming up with a product or services that's going to make life better for millions of people.
Well, and that's the thing we were talking about before the lights came on, right? That this gets incredibly personal for people really fast. Like I brought up my grandmother who passed away this past year. I was thinking about how these things might have helped her. Does that raise the stakes for some of this technology for you? The fact that it's so personal and it's for such an important moment in people's lives?
Well, absolutely, because I think that human dimension of what we do, how do we help people live and age better, I think is so important. And for us, this increased longevity, the worst possible thing is for you to live to be 100 in poor health. And so we want you to be vibrant and healthy and be able to exercise and go out and do all those experiences that is not age related, that we all want to do those kind of things. And to see these young innovators here partnering with us to come up with solutions that in most cases are ageless. It's not that it's just for old people. It's, many of the solutions that you see, whether it's around regulating your heartbeat or showing you how to relax, some of those different kind of technologies are helping you to manage your finances better. That's ageless. And I think that's so important. And one of the cool things that ARP is in there, not just for older people, but for people of all ages.
Yeah, I also have to ask, what are kind of some of the key issues that you guys think tech can solve imminently, soon, or at least help with substantially for older people? Are there any that you're really thinking about, like this is one that could make a difference today?
Yeah. So I would say in the healthcare space, it's a lot about mobility and also keeping track of your vital health, your vital health predictors, whether it's about heart or diabetes or, your regulation of your medicine and sort of those kind of things. I think in the financial space, it's making sure that you're not being scammed, that you're protecting your financial resources, because we know that we hope that you're going to live 10 to 15 years longer than you probably planned for financially, and how do you do that? And then I would say the other is around the issue of isolation and enjoyment and personal fulfillment. And I think coming off of COVID, we all learned that, hey, technology is the key for so many things, and we all learned how to Zoom and, be fluent in Microsoft Teams to be able to connect with our colleagues or
Skype,
our friends or families or whatever. And I think, what came out of that is how important it is that technology is allowing us to have virtual doctor visits or even to stay in the workplace longer, because you're not having to go into an office and do those kind of things. And so it's super cool to be able to interact with all of these different technologies. And as I was walking around the day, I was like, okay, you solved this for, keeping track of your vital organs. But hey, if you could put that into a cool little, iPod or something that looked like a music, but it was also assisting me in hearing. How cool would that be, so that we could get rid of that stereotype of, hey, you're older, you have to wear a hearing aid. But it could be, to listen to music, or it could be collecting your vital statistics and those kind of things.
It could be doing more than just helping you hear.
Absolutely.
Last thing I wanted to ask you, you're here with an incredible slate of people. Steve Case, Grant Hill, Ken Jeong. AARP can really command some star power, and I'd love to know why you think that is.
Because we're cool. I mean, no, I think you're cool. I think that the issues that we cover is important to people in their own lives, and we see that every day. I've known Grant Hill for many years, and the work that him and his parents have done, particularly around in communities. And I know that Lauren and Seth Rogen, who are going to be with us, they've started their own foundation that's around dementia. And so most of them have a connection between the mission work that we do at AARP. And I'm so glad that, we have a brand that these entertainers and people who have these vast amount of followers are happy to engage with us on.
That was AARP CEO Joanne Jenkins. Straight ahead, we'll put dry January aside for a few minutes and chat with the CEO of Corona and Modelo maker Constellation Brands. That, of course, is Bill Newlands. You see him there right on the screen. We'll be right back. Investors still have shares of Constellation Brands on their watch list after the company lowered its guidance for the year, citing higher raw material costs and several other recent headwinds that offset an 8% rise in beer sales. Constellation Brands CEO Bill Newlands joins us now. Bill, Happy New Year to you. Good to see you as always. So I think the outlook may have caught some folks by surprise. Is it more that you're still seeing stubborn inflation in the business, or consumers are pushing back a little bit on some price increases?
A couple of things, Brian. First of all, inflation, while it seems to be off its peak, is still higher than it was prior to pandemic. So we're being very watchful about that because, a lot of our input costs go in today, even if inflation continues to go down. So that's certainly a challenge. The other thing is, consumers at times, when you take pricing, and we took some additional pricing in October, have some short-term sensitivity to it. Fortunately, the strength of our brands helps to overcome that. We actually gained more share in Q3 of this year than we did in Q3 of last year. So we still have a very strong consumer base, but certainly the inflationary environment has hung on a bit longer than we had hoped.
There had been some focus at the midpoint of last year, I believe it was, around the depletion rates. Where are you seeing some improvement, perhaps, in that part of the business?
Well, we have a number of things that are performing very strongly. Our Chelada business, our Pacifico brand, both are up over 40%. So those year on year have done tremendously well. We did see some minor softness late in the quarter because it came after the price increase that I touched on a bit ago. But fortunately, we've already seen the turnaround in California, where most of the softness was noted. In December, we already picked up 7 points versus what the going rate was in November. So it's very typical when you raise price to see some of this short-term impact. And we fully expect that things are going to continue to go well for us going forward.
Hey, Bill, it's Julie here. We are, of course, in what some have dubbed dry January, and I've noticed some sort of think pieces lately about Gen Z, I'm speaking for myself, Gen Z, not drinking as much as prior generations. And I'm just wondering if you've seen any of that show up in your consumption trends, in your volume trends, especially as you look across demographics.
Actually, this year, people feel like there'll be a little less of it than there has been in some other years. Again, that remains to be seen. But, one of the things that we're doing, we're adding this March Modelo Oro, which is the gold standard in light beer, into the Modelo brand after some great test markets this past year. We're also doing Corona non-alcoholic this year to touch on those very scenarios if and when they play themselves out. So we're very aware of it. Frankly, I don't think it's going to be as much as we've seen in some prior years, but certainly there's an element of the population that engages in that behavior.
And Bill, this seems to be shaping up to be the year of the ready-to-drink cocktail. You have the Jack and Coke product that's starting to roll out in the markets. You have the success of High Noon. How do you plan to attack this market this year?
We've done a number of things. First of all, our Fresca alignment with Coca-Cola is out in the marketplace, and those are just fantastic liquids. We have both a Paloma and we have a vodka spritz in that area. Also, our Chelada franchise really competes in that same area. We've added a 12-ounce and variety packs and a whole host of new options that open up new consumer occasions and new drinking occasions, and frankly, new consumers as part of that whole effort. So we think that whole convenience betterment trends are all going to continue, and we're going to play a part in it.
One of the kind of components to how companies are restructuring their costs right now in advance of how much a recession might impact their businesses on their marketing spend. That's something that a lot of the food, beverage companies can't really do as much, especially when you think about some of the shifts in certain events that you would typically get your name or your brand around, as was acknowledged in this most recent earnings report. And so what does that real marketing spend and the kind of cost associated with that look like given some of those shifts?
Well, we're at a point where we are the loudest share of voice in our industry, and we're going to maintain that. We believe that continuing to speak to our consumer in these inflationary times is critically important. And we're doing it with Modelo, we're doing it with Pacifico, we're doing it with Corona, and we're going to continue that. We think that's good for the long-term element of the franchise. I think it becomes too easy to cut spend or to do things differently at a challenging time. We think it's a time to make sure you're continuing to engage with your consumer.
Bill, real quick before I let you go, is beer still recession-proof? And I bring this up because before you came on this past week, and I bought myself a Corona Premier at the bar. I paid $9 for it. I know it's a in-demand brand, but I started to think, should I be trading down to save a couple bucks here?
No, I wouldn't trade down. I think you made a great choice. So thank you for that.
But really, do you think, even in a mild recession, do you think beer will be as recession-proof as it has been in the past?
It's fairly recession resistant. The consumer still looks at many of the categories in which we play as an affordable luxury. And it's a critical piece of what they do for enjoyment. So I think we are going to continue to see this be an important category that does well. And certainly our brands will be at the forefront of that because of their sheer strength in the marketplace.
Bill, good to see you. Bill Newlands, Constellation Brands CEO. Thanks a lot.
Thanks very much.
Coming up to the moon, literally, the CFO of Planet's going to join us in studio to discuss the company's latest ventures. Next. Satellite imagery and data company Planet announced this morning it has completed the acquisition of climate tech company Salo Sciences, moving a step closer toward understanding forest conservation and helping combat biodiversity loss. Joining us now is Planet CFO and COO Ashley Johnson. Pardon my transposing there for a moment.
It's an important conversation as well.
So let's talk about that, because we were just talking during the break. You came to us from the Bay Area, where obviously there is a lot going on from a climate and weather perspective right now. So what does Salo do, and how is its data being used?
Yeah, absolutely. Salo is a company we've been partnered with for a while, so it was exciting to have them actually join our team. Salo uses algorithms to measure forestry carbon. So you can think about the importance of that for companies that are looking to offset their carbon emission. They're essentially buying these carbon credits. They want to know that these are real. They want to have transparent, accurate measurements of that. We also work with them on things like understanding the amount of trees across California for fire observatory and fire risk management. So really important company, and we're really excited to have them on the team.
Something that's really amazing about Planet Labs is kind of the makeup of where your revenue is coming in from, whether that be government contracts, whether that be companies that are just looking for better insights that you can provide them as well from some of the satellite imagery, and then additionally how you're continuing to launch in order to get some of that imagery intact. And so purely, I guess, focusing on the government side, where does that really kind of make up the large growth of your business versus some of those other categories as well?
You know, what Planet has done that I think is great is in the Earth observation industry, historically, you saw companies that were really gearing solutions towards government only and really thinking about large, very expensive satellites that only a government in the end could afford to buy the data from. We've really shifted that model, and we provide to the governments the same service we actually provide to commercial entities, which is the daily monitoring of change going on the planet. It's a data subscription model, and with acquisitions like Salo Sciences, we're building solutions on top of that to make this data more accessible to companies that may historically not have worked with Earth observation imagery.
And Ashley, as a CFO of a growth company, how are you balancing that growth, that go-forward outlook, with the reality we might be in a recession at some point? Have you had to make tough choices in the business?
We always are making tough choices with a company like ours, where we have a very complex R&D organization. We have a team that's building satellites and thinking about the next generation that is going to be launched in 3, 4, 5 years, as well as the software solutions that we're building on top of the data. So we're always looking at what is the ROI of those investments and making these investments very carefully. So we went public last year and raised a lot of capital, which was exciting. But we're very careful to make sure that that capital is going to sustain us until we are cash flow break even.
Have you had to cut anything back, any projects you would have thought you were going to undertake this year?
No, everything that we said we were going to do is really what we've been doing over the last year, and we're seeing the results of it. So we're proud of the investments we're making and really proud of the execution of the teams.
Have you seen any pullback on the part of clients as of yet in terms of what they're investing in?
Sure. We have, on the commercial side of the business in particular, we have companies that do have to think about their budgets, and the investments that they make with us are important to the business, but they're also trying to make everything work. So that is a conversation that we have with some of our commercial customers. There's nothing that we're really seeing on an industry-wide basis, and I think a lot of that speaks to the criticality of the solutions that we're providing.
Operationally, is there a tapering of the number of launches that need to be done in order to continue to have kind of the baseline operational approach for the amount of imagery that you're able to have in the skies right now and provide to some of those core customers? And what does that kind of tapering timeline look like?
Yeah, so the way to think about it is right now we have about 200 satellites in orbit. Our smaller satellites that are imaging the Earth every day have a useful life of about 3 to 5 years. That means we're replenishing about 1/3 to 1/5 of that fleet every year. And in fact, just last week, we launched another 36 satellites as part of that replenishment. And then on our high-resolution satellites, we have 21 of those in orbit. We're currently working on the next generation. We call that our Pelican fleet. And we have a new fleet that's in progress, which does hyperspectral imaging, which will be the first of its kind. And that's another fleet that we have planned for the coming years. The first demo satellite's intended to go up this year.
Where do you think we are in the cycle of this industry? I mean, it feels like we're very early on. At the same time, there is a limited amount of space up there at the end of the day, and there's already concern about how many satellites are in orbit. So what do you think the eventual potential is, and where are we now on that path?
It's a really good question. I think we're actually really in the early innings. There is a lot of space, so we do care about space junk and space congestion, and we spend a lot of time on that. In fact, we fly such low orbit satellites that when the useful life of the satellite is over, they effectively burn up, and we release that space back, I guess, if you will. Mm-hmm. But in terms of the industry, it is really early innings. Last year was transformational to the industry. We've talked a lot about the tailwinds that are driving the industry, digitizations of economies needing to have access to this data, sustainability trends needing to understand the environmental footprint, where you see climate change and what's causing it, and then peace and security and the impact of peace and security on the global economy. And we really saw that come to light last year. I think all of those tailwinds are starting to open up new markets for Earth observation. And so I expect the industry will continue to see new entrants. Planet's obviously had a very exciting year, and we're excited about the market opportunity to come.
A really important business operation. Thanks so much for joining us here on set. In studio, Planet CFO and COO, Ashley Johnson.
Thanks for having me.
Absolutely. Coming up, the world's top-rated restaurant is closing its doors. We're going to tell you why next. Welcome back, everyone. Time for Cut for Time. 3 stories, 1 minute each. We start with this today. Apple sees $2.5 billion in iPhones exported from India between April and December. Now, that's nearly twice the total from the previous fiscal year. Some upbeat news for the tech giant as, get this, it celebrates 16 years since Steve Jobs introduced the iPhone to the world for the first time. Where were you when? My goodness.
Yeah, I know, exactly. So this, just to linger in India for just a second here, Bloomberg is reporting those numbers, and what it really signifies is a significant shift in manufacturing from Foxconn and dependence on Foxconn. A lot has been made of the fact that Apple is so reliant on that China supply chain, and so this now just evidence that they are diversifying that supply chain.
And if anyone is going to diversify that supply chain, it's Tim Cook, the former COO. He's an operations wizard in many respects. But Brad, where I was using a BlackBerry when that phone came out. I mean, BlackBerry just dominated, I think, so many of our lives, and the iPhone just came out of nowhere and just crushed it.
Had all of us on BBM for far too many years.
Which is now an app, I believe you can download from the Apple Store. All right, Taiwan's Evergreen Marine Corp making quite the impression on its employees as the shipping company reportedly hands out year-end bonuses equal to 50 months' salary, or more than 4 years' pay on average. Hat tip to this company just getting it done. Of course, it's been a very challenging time during the pandemic for workers in this space. Good to see them doing this.
I think this also speaks to the shift that we've seen in terms of some of the operations and in decreasing the reliance on China for some of either its production or shipping necessities, and that's across some of the products-based industries, and leaning into other other countries where they could see some type of I don't know, better operational negotiation perhaps on the supply chain front. And Taiwan, one of those beneficiaries from that, at least in this interim period of time.
I mean, this is also just a reflection of how busy it's been in shipping, right? And that it's been, I'm sure these employees have been working long hours and they've been working really hard. You know, they also, remember, this is the same company that had to get a ship loose from the Suez Canal, right? So, you know, they deserve a bonus. After repeatedly topping lists of the world's best restaurants, Noma is going to close for regular service at the end of 2024 and become a full-time food laboratory that will still have some special events. But Noma sort of pioneered hyper-local experimental cuisine. I saw a figure today that a dinner there with beverage pairings will set you back something like $725 or $750. So this is really high-end dining. And the guy behind it talked about how fine dining has really changed. It's stressful, it's long hours, it's not as relevant and as sustainable as it once seemed like it was.
I mean, yeah, that is quite the check that you're going to get at the end of that experience. I have never heard of it.
I've seen you there a couple times, Brad. No.
Oh, yeah, no, not at all. Not Monday, Tuesday, any day that ends in Y.
Yeah, no, I've never been there too. I'm more of an Olive Garden guy, of course, ticker symbol DRI.
Yes, unlimited salad and breadsticks. Yes.
Well, you may not have eaten there, but you have probably eaten at other places that were influenced by there, because it's a hugely influential.
Yeah, the steak at Olive Garden tastes like it. Absolutely.
All right, coming up, Rochelle Akufo is going to talk Tesla with Wedbush analyst Dan Ives. Keep it right here for that as we see stocks at the highs of the session. Nasdaq up by 2%.
Salad is just so good.
Banging it.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast and 8 a.m. on the West. I'm Rochelle Akufo, and here's a look at what I'm watching today. Now, in the green, stocks build on Friday's rally after a positive tailwind from China's reopening. Goldman Sachs now seeing a big upside for the nation's equities. Tech shares jump with Baba leading the pack on hopes that the tech crackdown is over. And boiling point. Tesla owners in China aren't happy with the price cuts, showing up in force at various showrooms and distribution centers to vent their frustration. We check in with Wedbush's Dan Ives on the trajectory for the world's EV leader. And from China, going now to India. We take a closer look at Apple's strategy in the world's biggest democracy amid reports iPhone shipments from India almost doubled last year. But first, let's take a look at how the major indices are faring 90 minutes into the trading day. You see the Dow there up more than 240 points there, near its session highs. The S&P 500 there up more than 46 points, up just over 1%. And the tech-heavy Nasdaq there up 1.8%, up nearly 200 points as well. Let's also check in on what we're seeing on the Treasury side action as well. We're seeing we're seeing a mixed picture here. The 5-year just barely in negative territory there. The 10-year relatively flat, and then the 30-year up just about 0.5%. So relatively flat there for bonds right now. All right, well, let's turn it over now to Yahoo Finance's Ines Ferret with more on the latest market action. And there's a lot of movers right now.
Yeah, that's right, Rochelle. And we are seeing a nice rally on top of the rally that we saw last Friday. I do want to point out the U.S. dollar index because this is very important. Last Friday, I'm going to put up a 5-day chart. You saw that dollar index at just above 105, and then it went down. This was after that jobs report. Right now, we're looking at it at 103.06. So as the dollar index goes down, that it's the U.S. dollar compared to other currencies, then that helps support equities. And that's what we're seeing right now. Let's take a look at these sectors. We are seeing most of the sectors that are in the green. A bit of a risk-on day. You're looking at technology, consumer discretionary, materials that are leading the gains right now. And over on the Nasdaq 100, some of the mega caps that are seeing gains. We're watching Apple up more than 2%, Amazon up 3%, Nvidia is higher, Tesla up 7%. I mentioned Nvidia. I'm going to pull up a semis chart right here, and you can see a nice pop for these semiconductor chips. Also, the Chinese ADRs, some of these are seeing gains on top of the gains that we have seen with those recently. Want to mention the crypto space because Bitcoin is up for a 6th straight day in a row. And remember that crypto trades 24/7. It's right now at $17,000 to almost $300 per token. And this is also giving a boost to the crypto-related stocks. So if we look at the charts right here, you can see Riot up 14%. Coinbase up 14%. Do want to mention also our analyst call on Coinbase, and that is Jefferies initiating Coinbase with a hold, with Jefferies talking about the FTX debacle and how that is a negative for Coinbase, certainly also for trading volumes. But he was pointing out some interesting points about the company's brand, its scale, its healthy balance sheet. That should help Coinbase weather the crypto winter that we've been watching. Rochelle?
All right, thank you for that market roundup. A lot of movement that we're seeing this morning. Ines Ferrer there for us. All right, well, TD Ameritrade's Investor Movement Index remained flat at 4.17 as 2022 came to a close, with clients ending the year as net sellers of equities overall. However, despite the sells, investors still found some individual names worthy of a buy. Here to break it all down is Sean Cruz, TD Ameritrade Head Trading Strategist. Good to see you, Sean. So, obviously, we did see a broader sell-off in equities in that 5-week period of the IMX index in December, but some opportunities there. What are clients buying?
So we actually saw clients come in and actually look at some of the names that have really been getting beaten up throughout the entire year of 2022. But we saw electric vehicle makers like Tesla, Rivian get some interest. We also saw some of the more popular tech names that have really been getting hit pretty hard, like Amazon, Apple, and also some of the semiconductors. But I do think it's interesting that they weren't buying semiconductors across the board. They were buying some names like Intel, but they were continuing to sell NVIDIA for the second month in a row, which I thought was interesting. So semiconductors, it looks like, is becoming a little bit more of a stock picker's market within that sector.
And it could be the same said for tech as well, because obviously we're seeing Meta, one of the tickers that we're seeing a lot of clients selling in this space as well. What are some of the ones that they're trying to veer away from, what they're selling off at the moment?
So I'm sorry, it got a little noisy in the background just now. Did you ask what they were selling?
Yes. What are the clients selling in that December period?
So one thing I think NVIDIA was being sold for the second month in a row, and I do think that's noteworthy. One, they had a pretty good earnings report in November come out, and clients actually used the strength off of that report as an opportunity to unload some of those shares. But then you got a little bit of a second draft of negative sentiment come out in the semiconductor space in December. They used that weakness to buy some names, but they still went out there and they were selling a name like NVIDIA. So I do think looking at some of the selling pressure we've seen there, also a little bit of selling in some of the energy names as well. I think crude oil has been a little bit more in focus. It's been a lot more volatile with just a lot of the sentiment around the growth outlook and how that drives demand, changing the price of crude. So I do expect that actually to be a little bit more of a volatile month-to-month industry when you look at energy names as far as what is being bought and sold. Energy having a pretty good day today. That's helping some of the oil services names out there in particular. But I do think energy is going to be an interesting sector to watch here as we get into the new year.
And Sean, as we dig into the demographics, what you've seen with millennial clients, even though they reduced their exposure in December as well, you saw them as being net buyers of equities. Why is that?
I mean, one is they have a little bit more of a long run horizon. They also tend to sort of lean towards some of the more, I would say, growth-oriented technology names. So when you do see a little bit of a divergence there between the overall population wanting to be sellers, but the millennial base still being net buyers overall, I think it just shows that when you do see some of the weakness that we have seen out of these technology names, because they have a little bit more of a longer run outlook, they might be one of the first client bases that are willing to step in and use some of these pullbacks as buying opportunities.
And are we seeing retail investors acting the same way as institutional investors right now? Because obviously a lot of volatility, a lot of uncertainty coming into 2023.
Yeah, I do think there's a little bit of overlap, and a lot of the issues that you saw a lot of institutional investors mentioning were also front of mind for retail investors as well, and that is Fed aggressively hiking interest rates, sort of putting their foot on the brake here, but that's also going to have some implications for overall economic growth expectations coming up, what that can mean for corporate earnings, which we're going to start getting a pretty good look at this week when we hear from the big banks, but then also the outlook for inflation, and if we do start to see inflation coming in, what that could mean for monetary policy. So I think a lot of the issues that institutional investors are looking at are what retail investors are focused on, and you're going to come to the same conclusion. If you are concerned about those items, you're probably going to want to deleverage. You're going to want to get a little bit more defensive in what you're holding. You're not going to go out as far on the risk curve and stick your neck out in some of those companies that aren't profitable or have a lot of volatility in their revenue and their earnings. You're going to steer clear of those if that is the environment that you see yourself investing in. So to that extent, we did see institutional and retail, I think, behave in a similar manner over the year.
And it's hard not to get excited when you see these rallies. Obviously, we see that continuing from Friday. But do you think that clients are pricing in enough risk at the moment for the year?
One thing is that whenever we've gotten these rallies where you get some sort of data point that indicates that maybe inflation is going to start to soften up or is not going to be as bad as we had seen it over the previous months, you get a rally on that. And I always say be a little bit careful when you're rallying off of hopes that this means the Fed's going to be able to pause or dial back how aggressively they're hiking rates. Because one thing that has been consistent, every time we get some sort of a economic data point that points to softening inflation, the market starts to say, could this be what allows the Fed to maybe dial things back? That usually, shortly after that, we get another data point that maybe points to inflation remaining somewhat firm, and you see those rallies get reversed just as quickly as they happened. So you don't want to throw water on this entirely, but we just got one data point on Friday that's a little encouraging with softer than expected wage growth and the employment report. But this week we get a lot of inflation data out. You're going to want to focus on that, because if that does come in a little bit firmer than expected, then you'll probably see see this rally reverse itself fairly quickly.
And obviously, hope isn't an investment strategy. People need to keep that in mind and not sort of get caught up in a lot of the noise here. A lot of people also waiting to see what's going to happen if and when the Fed pauses in 2023. How do you think you'll see retail clients shift?
So if we do get a good sense that the Fed is going to pause, or they feel like they've hit a good level that they can then hold rates at, I think you'll see investors start to come in and take on a little bit more risk, and some of the trends that we saw throughout 2022 could begin to reverse themselves. I don't know that we're going to go all the way out and get into some of those riskier, more frothy valuation type companies, but I do think you'll just start to see a general flow back into equities out of some of those safer areas of the financial asset spectrum. That'll be the first thing to happen, but I do think markets right now want to get a good sense for where the Fed can finally be in a position to pause. That'll be the first shoe to drop. Then they may start looking at maybe a potential rate cut, but you need to see significant progress on inflation back below that, at the very least 5% level, which I think we are still pretty far out from. So right now, the first thing you should keep an eye on is if the Fed will be in a position to finally stop hiking rates here in 2023.
Something I know the markets will be bracing for. A big thank you there to Sean Cruz, TD Ameritrade Head Trading Strategist. Thank you for joining me this morning. All right, taking a look at what we're seeing with Alibaba shares. That's after news that co-founder Jack Ma is surrendering control of subsidiary Ant Group to appease regulators. You see there the stock up almost 4%. Now that's after its cancelled IPO in November of 2020, led to a regulatory-driven restructuring. Now, investors see Jack Ma's latest move as a positive for Alibaba, leading to a boost in sentiment as Goldman adds the e-commerce company to its conviction list and reiterates its buy ratings on several other tech firms as well. All right, coming up, Tesla owners in China have been protesting against recent price cuts, feeling they've overpaid for their electric vehicles. We'll get into the move by Tesla and what it means for its 2023 sales outlook next. Some interesting data coming from a big strategy shift at Apple. The tech giant nearly doubling iPhone exports from India between April and December. This is according to reporting from Bloomberg. Well, joining us now to discuss is Yahoo Finance's Dan Howley. A lot of people were wondering what was going to happen with diversification away from China.
That's right, Rochelle. This is basically Apple's long-term play where they're trying to ensure that the kind of mess that they saw as far as the supply chain problems in China doesn't repeat itself. We saw, obviously, at its main iPhone facilities, there were those protests as well as lockdowns that prevented Apple from being able to get as many iPhones out on the market as they wanted to. As a result, we still see some supply issues with the new iPhone 14. So what they're doing is, and they've been doing this for some time, it's just the kind of shutdown over the past year has really accelerated this effort. They're trying to move out into the likes of India as well as Vietnam, but in India in particular, they're building the new iPhones. Now, they usually leave the newest iPhone model to the workers in China through their manufacturing partners like Foxconn, mostly because they're the most reliable. They're the ones that know how to do this quickly and efficiently and ensure that they have those iPhones out on the street as fast as they can. They're getting that kind of expertise out of the workers in India now, though, and so they were able to get them up to speed on the iPhone 14 relatively quickly, and they'll be continuing to move more and more manufacturing outside of China as they kind of ensure that they don't have a single block for their kind of supply chain. So expect to hear more about this in the future. It's worth pointing out, though, that the vast majority of iPhones, as well as Apple products in general, are still made in China. So this isn't as though we're seeing a huge, shift right now. It's a shift for sure, but the vast majority are still built in China, and they will continue to be built in China for years to come.
And that's important context, obviously, not going away from China anytime soon. But I want to hone in on India because there are reports swirling that Apple could soon open its first flagship store in the nation. What are you hearing?
Yeah, there's been talk about this for some time, and it looks as though we're finally getting movement. There was the potential for them to be opening a store in Mumbai at one point, and then there were obviously a little bit of problem called COVID put the kibosh on that for a while, and so now they're going back to that, and they should be able to open up their own physical retail presence in the country in the next few months. And they have online retail sales. Tim Cook has said, though, that he doesn't want third-party retailers being really the main people that sell iPhones in the country or Apple products in general, just because it doesn't have that same kind of control over the brand when third-party retailers are selling it or third-party resellers. So they're going to be opening their first store in the country. It is also, though, important to note that iPhones are still incredibly expensive for the average person in India. So though they're opening a physical retail store, though you can buy them online, this isn't something that the average citizen in India or consumer in India is going to be able to go ahead and buy. It's a very pricey item, and so expect Android phones to still dominate in the country for some time. You could consider the iPhone almost a luxury item there.
And of course, when you talk about phones, you have to talk about chips. So we're also watching NVIDIA shares this morning as well, Dan.
That's right. Cathie Wood is offloading some of her shares of NVIDIA. This is something that she's done previously as well, though NVIDIA has been one of her almost favorite stocks. And it comes after NVIDIA announced a number of new products at the CES, the Consumer Electronics Show. They showed off their new mobile processors as well as a new desktop processor, talked about getting to work with Foxconn with their efforts to build an electric car using some of NVIDIA's technology. So there's been a lot of news about the company, but they are down dramatically year to date, over the last 12 months. I'm still in December for some reason. But over the last 12 months, they're still down very, very much. We're talking around 50% as far as we've seen them. So, you can look at the chip market at this point, and you can try to think that we're at the worst part. But, the supply chain issues that have roiled the industry, they're still trying to get over the huge amount of inventory that they had built up, expecting the demand. But now there's no demand. So they're just sitting there with all of this inventory that they're trying to work through. So NVIDIA, Intel, AMD, a number of these chip companies are still suffering.
Certainly keeping an eye on that glut, as you mentioned there, in the system. A big thank you there to Dan Howley. Thanks so much. All right, well, Tesla owners in China aren't happy about these recent price cuts. Footage from Chengdu over the weekend shows dozens of customers showing up at a showroom in the city. This amid reports of similar activity at various distribution centers as customers vent frustration at the changes, demanding everything from rebates to credit. Now, the EV leader cut prices by 6% to 13.5% on certain models on Friday, stoking concerns of a growing price war in the nation. Now, of course, after a tough year, short sellers remain laser focused on the group's shares. That by the end of December, CEO Elon Musk said he would not shed any more stock in the company, and that's after months of selling. Well, joining us now is Dan Ives, Senior Equity Analyst at Wedbush Securities. Good to see you, Dan. I first want to start with obviously this consumer backlash that we've seen in China. There was a price cut in certain models in October. Again, you saw the subsidies come off in December. People thought they were in the clear. So this really on Friday, this another price cut really hitting home for a lot of consumers in China.
Look, but Tesla had to rip the Band-Aid off. I mean, in terms of price cuts, what we're seeing in China, I think they could still cut prices another 5%. And margins, I think could be relatively range bound. I mean, soften a bit because of the scale that they now have in terms of Ginga Shanghai. But ultimately for Tesla, it's about getting in front of this, not behind it. And ultimately, I think if you look at what growth's going to be in China after these price cuts, I think it's going to be strong. A strategic poker move by Musk, I believe, that was a real smart one that they did early.
And this was something that they really needed to stoke demand. It appears to be working. We're seeing some reports from Reuters saying that there could be now delays in some models because of the spike in demand. What do you think this does, though, when you look at this picture for Tesla's bottom line?
Well, we were hearing that from Chinese consumers. I mean, any types of work that we've done, they had to cut prices. And this is after price increases, clearly a softening macro. And look, I think for Tesla as well as others, in terms of autos, not just in China, but globally, I mean, the clock struck midnight. You're starting to see cracks in the armor in terms of the macro. They need to cut prices ahead. They have that flexibility because of much more scale globally. And I think it's the right move. And I also believe the stock, you're starting to now see just so much bad news reflected in the name. Deliveries already came out. And I think we could start, right from here, I think the worst could be in the rear view.
And Dan, I mean, as we look at what we're seeing today with the stock price action today, up almost 8%. Obviously, we're seeing the broader markets also up as well, but not to the degree that we're seeing with Tesla. What do you think is driving this optimism?
Look, I think it's a crowded, bearish name. I still think it's under-owned here. I think 70% of the sell-off was ultimately Musk Twitter driven. And it's still one of the most transformational companies over the next decade. And if you're able to kind of see through this, so what I'll call near-term turbulence, I think this is a very attractive risk reward. And I think that's what's really playing out here is risk assets are way oversold. That goes for the likes of Apple, Microsoft, Tesla across the board. And the bears on this name were wrong for 12 years. They obviously were, very right last year. I think they're going to be wrong this year. I think there's a stock that's going to be closer to 200 than 100.
And I know that we still have, of course, one eye on what we're seeing with Twitter and the distraction there. And you said that the Tesla shares are becoming, quote, a massive risk reward to own. But obviously, you also have Leo Koguan, who's the third largest individual investor in Tesla as well, growing frustrated as well. When do you think this ends? Will it end when Musk finally names a CEO for Twitter and can focus on Tesla? Or will there be some other sort of catalyst to really get things back on track?
Well, I think there's three specific things that could happen. One, fundamentally clear the deck on numbers for 2023, said hittable to beatable numbers. Let's call it 35 to 40% delivery growth. Take out that 50% for the year. But the other two are non-fundamentally. Gotta name a CEO of Twitter. I believe over the next few weeks, because that's been part of the brand issues and part of the spider web with Twitter, as I think many shareholders have gotten increasingly more frustrated. And just put an edict out there, not going to sell stock, say it on the conference call. That's really been an issue. I mean, if you look at that personal ATM in terms of using Tesla Pay for Twitter, is in part of the overhang here. Musk started the 5-alarm fire. He's the one that could extinguish it. I believe that happens January 25th when they report.
And I want to ask you, there's obviously still an ongoing lawsuit that Musk has asked to be moved out of California because he believes that it's too negative there, that he'll have a better chance in Texas. And this is regarding when he was planning to take Tesla private at $420 a share. How much does this sort of weigh into sort of brand Tesla and really the trust that comes with the company?
Look, I wouldn't expect any candlelight dinners between Musk and California officials. And there's no level Austin clear. That's why more and more of Tesla is really going to be coming out of Austin and Texas in terms of production. Of course, you'll have Cybertruck. I think over time, a lot more brain trust goes from California to Texas. But look, this is obviously a darker chapter. That we're starting to continue to see some of these issues perk up. But I think for Musk and Tesla, it's about looking forward, and it's around no more brand deterioration. And I think now, if you look at EVs, we're still in the second, third inning of this all playing out after what's been a disaster year for Tesla over the last year with that Twitter overhang.
And you mentioned the Cybertruck. So as we sort of throw this forward, what are the expectations there? I mean, who is this actually targeted to?
Well, I mean, even if you look across the board from F-150 to Rivian to what we see from GM and others, I mean, this is really the year of the pickup truck, or I'd say on the consumer trucking side for 2023 with EVs. Cybertruck's important because not just in terms of what reservations look like, but just to have another product out there that they can monetize. That's a huge opportunity they can go after. And if you look, I mean, see, despite the stock price, what Rivian is doing in terms of the overall demand environment, this is going to be a strong area of demand. Now, I think the key for Cybertruck, making sure that ultimately hits in the second half of 2023, doesn't get pushed to 2024, because clearly that would be late to the game. But this is an important product in terms of the overall ecosystem of Musk and Tesla.
Certainly one we'll be watching. Hopefully no more delays and no more broken promises. A big thank you there to Dan Ives, Senior Equity Analyst at Wedbush Securities. Always good to see you. All right, coming up, shares of Macy's down this morning after warning of lower holiday sales, and Lululemon also trending ticker list. But why? We'll check on the retail sector when we come back. All right, we're taking a look at some retail movers today, starting with Lululemon. Now, shares are off more than 7% after the company revised its fourth quarter forecast, saying it expects its holiday quarter gross margins to decline as it deals with inflation and a drop in consumer spending. The athletic apparel brand also tightened its earnings expectations as well. And we're also watching shares of Macy's today after the retailer warned that it expects sales to be at the low to midpoint of its guidance of $8.16 billion to $8.4 billion, saying its holiday sales took a hit from inflation. Now, Macy's CEO also warned he expects the consumer to continue to be pressured in 2023. Well, let's take a look at today's chart of the day. Mergers and acquisitions saw a steep decline in 2022, falling 37% to $3.61 trillion. That's from the record high of 2021, according to Refinitiv. Now, rising interest rates and concerns over a possible recession contributed to the largest year-over-year percentage drop since 2001. But deals are expected to pick back up in 2023, so some optimism there. All right, coming up, we get you up to speed with the latest ETF focusing on key elements in the electric vehicle and energy storage markets as well. And we're joined by CEO of Element Funds, so stay tuned. Elements Funds launched its first ETF, zeroing in on the EV and energy storage markets. The fund will buy and sell futures of commodities such as lithium, cobalt, nickel, and copper, all metals necessary for EV technology. Element Funds co-founder and CEO Will McDonough joins us now. Well, good to have you on the show. So by focusing on the futures elements here, what does that mean in terms of avoiding some of the risk and the volatility that we have been seeing with the EV market?
Yeah, what we've chosen to do is give people a more direct exposure to the elements necessary for the future of battery technology, whether it be through solar, wind, or EV. You know, as we've seen and as is broadly covered, Tesla, but, you know, all of these EV companies have had a trying Q4 because they're trading at weird multiples that the market doesn't really know how to digest. And so, you know, when you think about Tesla trading at a 1.2 trillion market cap. We think that a lot of that demand was for investors not knowing how to play EV and wanting to participate in the adoption of EV. But they ended up the year down almost 70% when core assets for building Teslas like lithium was up 180%. So there was almost $1.2 trillion worth of investors who thought they were long EV adoption and ended up exposed to Musk dumping shares and Shanghai shutdowns and external factors that really had nothing to do with, whether or not quarter over quarter there's EV adoption or not.
So then what does this mean in terms of return on investment in a fund like this?
We, come from private equity background, so we expect to deliver private equity-like returns with equity-like liquidity. We think that these assets are wildly underpriced, and we think that the market demand for them has not been figured out yet. If you look at global governments with, carbon neutral targets that they've made in the coming 5, 10, 15 years, the amount of adoption that is going to need to be for that to even come close is going to drive demand to these core elements necessary to build these batteries that our infrastructure isn't established yet to provide. So when you talk about some of these mining companies that we depend on to deliver these assets, if I found lithium under my house today, it would take 8 to 12 years before I could get that into a battery. And the markets that we depend on for these assets are majority China, a lot of Democratic Republic of Congo, some, Brazil and Chile and Latin American countries with governments that aren't democracies. And as we saw with, some big news last week and over the course of the last month, one of the world's largest copper mines in Panama was shut down because the Panamanian government said, we need a massive base tax to allow you to operate. These are just markets that, our supply chains are dependent on that introduce a lot of risks to the price volatility of these core elements and metals.
So then when you're deciding, given those risks then, when you're deciding what's going into this ETF, what are some of the criteria that you're using?
We have a great team of folks that really own these core assets up and down the supply chain in partnership with the Energy Mineral Group out of Houston, a $13 billion private equity shop. And what we do is we look at per car company and per implementation of battery technology, what are global kind of quarterly and annual targets for cars delivered. So if Tesla's going to deliver 3 million cars and Tesla's using an NCM 811 battery that's 8 parts nickel, 1 part cobalt, 1 part manganese, that's a different battery than you're going to find in a Chevy Volt or even a Ford Lightning. And so what we try to do is look at the global universe of demand for batteries, the different types of battery technologies each of those use cases requires, and then what the resulting demand per asset are. So lithium, cobalt, and nickel are core to the majority of battery technologies today. Copper is not in the batteries themselves, but every electric vehicle requires almost a mile of copper wire per car. So the global demand for copper to connect these batteries to all of the sources and uses is massive as well. So we try to extrapolate all that data into a math equation that allows us to give investors real pure exposure to global demand for all of those underlying assets. And we are an actively managed fund, which means monthly we're going to reposition our portfolio to ensure that we're in tune with the times, and that as the price volatility comes and as appreciation rises, we'll be able to, redistribute into some of the underperforming assets. And then as battery technology matures, we're going to redistribute into, the underlying assets that drive, the demand and the ultimate optimal use of these battery technologies.
And as you've talked about, some of the mining for this, going from mining to get it into the cars, this is a multi-year process then. So what sort of time horizon should investors be expecting before they start to see some of the bigger returns on this?
Well, all of those long time horizons only drive shortages in supply. And when you have volatile and short supply and rising demand, regardless of the sector, that's undefeated for market price appreciation, which is why we brought this this product to market. As I cited before, lithium was up 180% last year. Copper was up 2% last week. I mean, these assets are in massive demand and their supplies are in question. And so we don't think that investors are going to have to wait a long time for a return. I'll also say, traditionally, the only way to play these markets has been in the private equity sphere. And so the answer to your question, if I were a private equity professional, would be, I'll call you in 10 years and we'll return your money to you with a return. Whereas in these markets with these ETF products, we're able to offer investors daily returns, and they can trade us on a daily basis. So they can take a long view on the macro, but trade it with liquidity, which I think is the holy grail.
And certainly a way for people to get in and try and avoid some of the volatility, as we mentioned, between Musk and some of these other EV spaces as well. A big thank you to Element Funds co-founder and CEO Will McDonough. Thank you for joining me this morning. All right, coming up, nurses at Mount Sinai Hospital in Montefiore, Bronx, on strike this morning in search of better contracts. We'll talk to a registered nurse after this. Vaccine maker Novavax has announced that John C. Jacobs will take over as president and chief executive officer, as well as a member of the board of directors, effective later this month. Yahoo Finance's Anjali Kemlani is following the story and joins us now live from the 41st annual JP Morgan Healthcare Conference. I mean, this is an interesting announcement.
It is, and surprisingly, one of the biggest for the start of the conference. But yes, Novavax CEO Stanley Erck saying that he is stepping down after more than 10 years at the helm of the company, bringing the first commercial product, the COVID-19 vaccine, to light. We know that, of course, the company had a bit of a troubled start in that space, but they do have that vaccine out there at a time when we know that vaccine uptake has waned. So not much more on details just yet. We are expecting to hear more from Stanley later today at the conference after hours, unfortunately, but we do hope to also have him on tomorrow, so stay tuned for that. But as of right now, not much coming out of him, really just a comment in a statement earlier today saying that, he's led this company through the, through to the COVID vaccine, through the pandemic, and it has been the highlight of his 40-year career in the industry. So he is definitely no stranger to the healthcare sector.
I'm sure that's stealing all the headlines, but what about other kinds of deals that have been announced so far at the conference? What are you keeping an eye on?
Well, we know that, deals really are the bread and butter of this conference, and that's really why it has earned such a big name. But really, we're starting off with the first day, not too many in sight, just 3 deals to speak of, and a grand total of maybe less than $5 billion in total. The first with AstraZeneca talking about acquiring Syncor. We also heard about QIAGEN acquiring Verogen. And then Italian firm acquiring Amrit Pharma. So just really, small deals, very specific, very niche, and nothing too big to brag about just yet. Maybe we'll be surprised and it won't be a day one, deal. But this is the conference where some of the biggest deals in the past several years have been announced. So we're sitting tight to see if anything comes through. But we do know that it is a harder year than it has been to start off with. In the last year alone, we know that the M&A volume, the investment in biotech definitely slowed down compared to the record year the year before. So all in all, really interesting picture, and really wait to see if maybe coming back in person is going to have any impact on this conference this year.
We'll certainly check back and see if it's a sign of things to come. Anjali Kemlani, thanks so much. All right, well, today, more than 7,000 nurses from Mount Sinai Hospital and Montefiore, Bronx, are on strike as they demand for a fair and timely contract that improves patient care. For more on this, we welcome in Michelle Gonzalez, a registered nurse currently on strike at Montefiore in the Bronx. Thank you for joining us today. So we know that there have been some tentative agreements for nurses at other hospitals, Mount Sinai Morningside, Mount Sinai West, that were reached late on Sunday. But how hopeful are you when it comes to Montefiore?
Hi, thank you for having me. We have been working diligently with our negotiating team and with Montefiore at negotiations for the past 3 months. This strike notice and this strike was not an easy thing to come to. We have been trying to negotiate in good faith for the past 3 months, and this strike notice was only placed on the table because our institution does not seem to find the issues that we are bringing to them of any concern. We want better staffing enforcement, and we want more nurses in our hospital to take care of our patients safely and provide the adequate treatments that they need. We are hopefully going to resume bargaining today with our employer. I do hope and I believe that we can come to an agreement, hopefully sooner rather than later. I don't know when that time will be because it'll depend more on what management is willing to offer. It does appear that over this last 10 days of our strike notice, that they have moved a little bit more in the favor of what we were asking for, which is to reopen some of the closed units that we had closed because our census or our volume was down, meaning we didn't have that many patients. However, now our volume is back up. So we're asking that they reopen that unit and that we stop placing patients in hallways. It's a practice that we don't think is safe for either the patients or for the providers.
And as you mentioned, it's not just about raising wages, it's also about some of these safe staffing ratios. I mean, if you have patients in hallways and things, it's not safe for staff, it's not safe for the patients as well. Talk about where we are in terms of the conditions at hospitals during the peak of COVID versus now.
Talking about COVID is sometimes like a trauma closet that we don't like to open up. But what happened during COVID has, I think, enlightened many healthcare workers, not just nurses, about our treatment and the level of respect that we receive from our institutions. It's nice when we're called essential workers and called heroes, but it's not nice when we're saying there's a problem in the hospital and nobody's hearing us. Nobody's making any substantive changes. We have an emergency room that is constantly and chronically overcrowded. Patients are struggling to get the care that they deserve. If a patient sticks their foot out of their stretcher, they are in the other person's stretcher.
Goodness. I mean, thank you for shedding some light on the conditions, because for a lot of us on the outside who don't know what's going on inside the hospitals, we do need that insight. We did also hear from Nancy Hagans, the New York State Nurses Association president, saying that there were ridiculously high nursing vacancies. So, I mean, in terms of, was this a problem that was months and months in the coming that just wasn't addressed?
So I think with regards to staffing has been a concern for nurses and for healthcare workers for a long time. And it's not just nurses, it's our respiratory therapists, it's our doctors are struggling with our patient loads. It's not just as nurses. But I think the short staffing affects all of us in the way that when we're trying to provide that care, we're unable to do adequate assessments to give the patients the kind of care and the time that they need.
And so if you had the ear of the mayor or of Governor Hochul, what would you want them to understand about this, given perhaps it does seem to be at least getting a little bit closer, perhaps on some of the demands and the needs?
I invite anyone and everyone to come to my facility in the Bronx. Maybe not right now, because I know that they have reduced the volume to get through this strike, but our normal volume of patients in our emergency room is about 200 at any given time. When you go and walk through this institution and you see patients in the hallway being cleaned, there is a level of indignation that arises in you as a person. And I know it can't just be me. So if anybody wants to come over and see what our conditions are like here in the Bronx, we are inviting them, any politician, to come and take a look at it. And then they can come and make any decisions on how Montefiore can help us get more nurses into this institution.
Well, it's great to hear directly from you there. Michelle Gonzalez, thank you for your time today and best of luck.
Thank you.
All right, coming up, from inflation to earnings, we'll take a look at what to know and look out for this week. A few key events for investors to keep an eye on this week. Tomorrow we'll get commentary from Fed Chair Jay Powell at an event in Sweden. When we heard back from him in December, he struck a particularly somber tone, mentioning the labor market tightness was an overhang of the devastation caused by COVID-19. And on the corporate side, Bed Bath & Beyond's latest report will likely make for some tough reading. Shares in the group, of course, bouncing back in today's session after some heavy selling off last week. And the main event for data watchers will be Thursday's CPI release, a reading that will likely dictate bets on the Federal Reserve's next moves. Now, economists are expecting headline inflation to rise 6.6% year over year in December. That's down from a 7.1% increase in November. Then it's over to financials. Big banks leading the way on results season. JP Morgan, Citigroup, Bank of America and Wells Fargo all report fourth quarter earnings on Friday. Now, investors will be keeping an eye on how their mortgage businesses are holding up, as well as listening for signs of optimism on the broader economy. All right, well, before we go, let's do a final check of what we're seeing with the markets right now. We're seeing the Dow up there, almost up about 1% on the day. Still enjoying some gains there. The S&P 500, they're up more than 1.33% there. And the Nasdaq there, tech-heavy Nasdaq, up more than 2% there, more than 220 points. Let's also take a look at what we're seeing in terms of the trending tickers. We talked about BABA earlier today and how that's been doing ever since that announcement from about Jack Ma and his succession plans. There we're seeing that's up about 3.8%. Also talked about what we're seeing with the retail industry as well. Lululemon, our top trending ticker, that's down now of almost 8%. So we're seeing those losses still accelerating at the moment. Also want to take a look at what we've been seeing with Bitcoin. Usually when we take a look at the broader markets, when they're rising, we tend to see Bitcoin rising as well. Same situation today, above 17,000, a welcome relief for those really trying to hold on for Bitcoin's gains, obviously still far off from where it was at the end of 2021, but just up 17,000 at the moment. But if you look down for the month, just there about 1.25% in the positive there. A lot of people wondering what's going to be that catalyst that really gets Bitcoin going again. We've talked about some of these valuations, anywhere from reaching 10,000 this year to perhaps even $1 million if you're Cathie Wood by the year 2030. So something that we'll definitely be keeping an eye on. Also keeping an eye on Macy's. Their ticker is down about 7.5% as well. So we'll be keeping an eye on what happens as we also have more earnings coming out this week. Well, that'll do it for now. I'm Rochelle Akufo. Thanks for watching. I'll see you tomorrow at 11 a.m. Eastern.